1.1 Investment and Saving Principles. It is important to understand the basics of investing before focusing on segregated funds and annuities. Concept of investing. What is the basis for the concept of investing? Investing occurs when money is used to make more money. The goal of individual investors is to invest a sum that will be repaid to the investor plus a profit called a return. The money available to investors from savings, or other means, is deposited to investments. That sum is known as the investor's principal or capital. During the period, the principal is held in the investment. It may grow, stay the same, or decrease in value, and when the principal grows, it produces a return to the investor in the form of principal plus interest or from capital gains or dividends. Investments may be guaranteed, in which some or all of the principal is guaranteed to be repaid to the investor. For some kinds of investments, some growth may also be guaranteed. Non-guaranteed, in which neither principal nor profit is guaranteed to be repaid. Examples of guaranteed investments include guaranteed investment certificates, and some bonds, or examples of non-guaranteed investments include stocks, mutual funds, and real estate. Example: Jean is 78 years old and relies on the returns from her investments to generate income to support her in retirement. Her investments, combined with her pensions, allow her to live comfortably. Jean feels that she cannot afford to risk her invested money in an investment that would not pay both her principal plus the stated return. Therefore, Jean chooses guaranteed investments to ensure that she will not experience losses. Investment basics. Some investment fundamentals are essential to understand how investing works, how returns are generated for investors, and how investors manage risk. Compounding, compound interest. Compounding refers to earning interest on an investment. When the interest is paid, it is reinvested in the investment. The next interest payment is based on the principal and interest already received. As a result, the investor earns interest on interest. This form of interest is called compound interest. Withdrawals reduce the effect of compounding. To maximize compounding, all investment returns must be reinvested. Refer to Table 1.1 to see how compound interest achieves escalated investment growth. Table 1.1. Investment growth escalated by compound interest. Year interest is received on 1. Principal. 2. Principal plus interest earned in year 1. 3. Principal plus interest earned in years 1 and 2. 4. Principal plus interest earned in years 1 and 2 and 3. 5. Principal plus interest earned in years 1 and 2 and 3 and 4. Etc., until the investment matures, or the investor ends the investment. Since compounding works better over a longer time period, younger investors have an advantage. This is why advisors recommend that individuals start saving as early in life as possible. Compounding can also work negatively. For example, costs, such as debt with unpaid balances where interest is charged, can also compound. Investment returns. All investments have one of 3 types of return. Investment returns can be positive and generate profits. Returns can be neutral where an investor receives the original principal, but no profit. Returns can be negative where the investor loses money on the investment. This is a risk of investing. The rate of return is expressed as a percentage of the principal or amount invested. This percentage can be positive or negative depending on the performance of the investment. Example: Salim invests $10,000 but receives $11,000 when he sells the investment. The $1,000 profit, $11,000 minus $10,000, is a 10% rate of return, $1,000 divided by $10,000. Investors may be given an expected rate of return prior to investing. Investing involves a scale of risk which indicates the likelihood of the investor getting their principal repaid. Investment risk can range from very low risk at the bottom of the scale to higher risks toward the top, with speculative risk at the very top. The lower the risk, the greater the likelihood of receiving back all invested money. Speculative investments carry the highest level of risk. The possibility exists of not getting any return or facing a negative result and losing money. On the plus side, speculative investments can generate higher returns than lower risk investments. The risk-return theory is, reward those who are prepared to take greater risk with greater returns. Those who are able to take less risk are not similarly rewarded. Less risk equals lower returns. Returns are classified as nominal or real. A nominal return is the named or stated rate of return, before considering inflation. For example, A 2% return advertised for a savings account is a nominal return. A real return incorporates inflation. Its formula is nominal return minus inflation equals real return. Example. If the annual nominal return on a Canada Premium Bond, CPB, is 2% and the annual rate of inflation is 1.2%, then the real rate of return on the bond is 0.8%, 2% minus 1.2%. Asset classes. Investments can have similar characteristics and be governed by similar laws and regulations. They are assigned to asset classes based on those similarities. Asset classes fall into three main categories. Stocks, also called equities. Bonds, also called fixed income or debt, and cash, also called money market instruments. Two other classes are often added to the three main asset classes, real estate and commodities. Each asset class has its own risk and return profile. Diversification mixes assets from the different asset classes. Diversification. Diversification is a strategy to manage risk. It spreads invested funds over the different asset classes. When asset classes and investments within those classes are combined, investing risk is lowered, and overall returns are higher, compared to investing all in one security. Economic conditions can vary by country. Diversification can be used to take advantage of favorable economic conditions with investments in other countries. Segregated funds are a good fit for a diversified investment approach. Segregated funds can be invested by their managers in a range of investments depending on the fund. For example, a segregated bond fund will invest in many different bonds that mature at different times, carry different risks, and pay out at different interest rates. Mutual funds and exchange-traded funds, ETFs, share similar diversification characteristics as segregated funds. Since most investors lack the capital to self-diversify their holdings, investing in a fund-type investment helps them to achieve and benefit from diversification. Liquidity. Investments can be termed as either liquid or illiquid. Liquidity describes how easily an investment can be converted to cash. In other words, is there a market ready to buy the investment? How easily and quickly an asset or investment can be sold without affecting its value. In other words, will the market pay a fair price? A liquid investment has the characteristics of liquidity. For example, blue chip stocks can be sold quickly without losing any value. An investment that does not have characteristics of liquidity is called illiquid. Real estate is often cited as an example of an illiquid investment, where a quick sell can result in a price below market value to get the sale made in the time available. Liquidity is essential in an emergency fund, in which a portion of earnings are set aside for emergency use, for example, to replace a sudden loss of income. The need will be for a timely sale at highest market value. Time value of money. The principle of time value of money is described in two ways. The present value of money, PV, and the future value of money, FV. Invested money has the potential to increase in value over time due to interest earned, or other returns. The difference in value between the same sums of money received at different times form the basis for the present and future value principles. Present value. Present value, PV, is an important calculation in many financial planning activities. PV works backwards from a future date. It is used to determine how much needs to be saved today to yield a specific amount in the future. For example, knowing how much needs to be invested today for a retirement nest egg in 10 years' time, or calculating post-secondary education expenses. Present value tells us that if $5,000 is needed at a future date, less than $5,000 needs to be saved today because today's sum will earn interest and grow over time. Example. Joe's daughter Sarah will be going to college in 5 years. He believes the cost of the first year's tuition and living expenses will be $28,000. He has just been paid for a large contract he completed. He needs to do a PV calculation to tell him how much of that money to set aside now to have the $28,000 when it will be needed. Present value can be calculated when the following are known. The future sum. The future date when the sum is needed. A specified interest rate between today and the future date. Financial calculators, available online, or in software provided by insurers, are used to calculate PV. PV is applied to both the sum of money and cash flows received over time. The formula for PV is PV equals FV divided by 1 plus interest rate, to the power of n. FV is the known future value and N is the number of time periods for the calculation, that is, yearly, semi-annually, etc. Example. Julie wants to know how much is needed today to provide $5,000 in 5 years, given the current interest rate of 3%. The present value of $5,000 in 5 years based on 3% interest is $4,313.04. PV equals $5,000 divided by 1 plus 0.03 to the power of 5. Julie needs to invest $4,313.04 at 3% interest today to equal $5,000 in 5 years' time. When do you calculate PV? If the target date amount is known and you want to know how much is needed today to have the required amount on the target date. In other words, if on target date, amount required is $5,000. How much is needed today? Calculation needed is PV. When do you calculate FV? If the amount today is known and you want to know how much this amount will grow to on the target date. In other words, today's amount, $5,000. How much will this amount be on target date? Calculation needed is FV. Example. Ted wants to know how much is needed today, PV, to provide $6,000, FV, in 5 years, N, where the interest rate is annual. The annual interest rate is 5% in the example. The PV of $6,000 in 5 years, based on 5% interest is $4,701.16. PV equals $6,000 divided by 1 plus 0.05 to the power of 5. In the example $4,701.16, PV, must be invested to provide $6,000, FV, in 5 years' time at an interest rate of 5%. Future value. The future value, FV, calculation provides the value of a current investment at a future date, given the interest earned on the investment, that is, how much should be put in savings or investments to be worth in X years' time. Therefore, if a future retiree has a certain amount saved for retirement purposes, he can determine how much that amount will be worth at retirement with a future value calculation. The future value can be calculated when the following are known: the amount of today's investment, the present value, the future date, the specified interest rate between today and the future date. Financial calculators can be used to determine the future value. The information can also be obtained from online calculators and sales resources provided by the insurers. The FV formula is FV equals PV times 1 plus interest rate, to the power of N. PV is the known present value and in the number of periods for the calculation, yearly, semi-annually, etc. Example. Sam has $5,000 today and wants to know the value of that sum in 5 years, given the current interest rate of 3%. The future value of $5,000 in 5 years' time at 3% annual interest is $5,796.37. FV equals $5,000 times 1 plus 0.03 to the power of 5. Sam will have $5,796.37 available for his needs in 5 years if he invests $5,000 today at 3% interest. 1.2. Investment objectives. Investment objectives are the reasons and end goals for investing and saving. These objectives, what the funds are needed for, and their time constraints, when the money is needed, will form the basis for investment decisions. Investment objectives fall into 3 categories. Short term, 3 years or less for the goal to be reached. Medium term, 3 years to 10 years. Long term, 10 years or more. Saving for a new car or the down payment on a home are short-term objectives. Saving for retirement is a common long-term objective. It is accommodated in savings plans for individuals and in group savings plans offered to employees who are members of group plans. Example. Small company is a technology company that needs to attract very specific computer programmers and mathematicians. These types of employees are in high demand in small companies' city. To make small company attractive to potential employees, it provides a very generous retirement savings plan. Knowing the client is the key to determining their investment objectives. In the case of a group plan, the client is the plan administrator, who is usually an employer. Account purpose. Both registered and non-registered accounts are available for the purpose of saving and investing. Registered accounts are individually registered in the owner's name with the Canada Revenue Agency, CRA. Non-registered accounts are also available for savings and investing, and have flexibility for deposits and withdrawals, unlike registered accounts. Registered accounts have specific features that align the account with its purpose. For example, a registered education savings plan offers government grants that help savings grow to help a child with post-secondary school costs. Accounts serve different purposes. For retirement, registered retirement savings plan, RRSP, registered pension plan, for group members, and the tax-free savings account, TFSA. For education savings, registered education savings plan and the tax-free savings account, TFSA. For the disabled, registered disability savings plan, RDSP, and the tax-free savings account, TFSA. Note, the tax-free savings account, TFSA, is a general savings account available for any purpose. These accounts hold the investment choices of the account owner. For example, an RRSP could hold guaranteed investment certificates and segregated funds. This means that investors can be dissatisfied with the investment choices in an account, but cannot be dissatisfied with the account type. If an investor is unsatisfied with the investments in their registered account, those investments can be removed and replaced with more suitable choices. Financial goals. A financial goal is created when an investment objective, such as retirement, is assigned a dollar figure, such as $500,000. Its purpose is to set a benchmark for saving and investing. Need for guaranteed investments. Guaranteed investments are the gold standard for those who are not risk takers. Why? The guarantee provides that some or all of the principal will be paid back to the investor when the investment term ends. Some profit may also be guaranteed to be paid to the investor. Investors will know any factors of timing that may apply to their investment, that is, they will know in advance when their invested money will be made available for their use, and investors whose income has become limited, for example, due to retirement, have the security of knowing their money will be repaid to them at a time when they are no longer able to regenerate that sum through employment. Time horizon. A time horizon is the time at which invested savings are needed according to the investment objective. Each objective has its own time horizon, and the time horizon is usually an event, such as retirement. The future value of money calculation can inform an investor what the value of their investment will be at the time horizon. Example. Martin has just received an inheritance of $200,000. His time horizon to retirement is 7 years. If he can assume he will earn 4% per year, in 7 years' time, his inheritance will be worth $263,186. FV equals $200,000 times 1 plus 0.04 to the power of 7. Tax-advantaged investing. Returns from investments are received in the form of interest paid by the least risky investments, taxed at the highest rate, the same as income earned from working, and foreign income including foreign dividends is taxed in the same manner as interest income. Dividends paid by stocks that normally have more risk than those investments that pay interest, and taxed at a rate lower than interest if they are paid as a result of owning stock in a qualifying Canadian company, because those kinds of dividends benefit from a dividend tax credit. Capital gains paid by or earned in the riskiest investments, taxed at a lower rate than interest, because only half of the gain is taxable. When the investment loses value, the investor receives a capital loss. 1/2 of the capital loss can be deducted from taxable capital gains on other investments, therefore, the capital gain may be reduced by a capital loss, and capital losses can be used in the year they are received, carried back 3 years, or carried forward indefinitely. 1.3. Types of investments. A life agent can sell segregated funds and annuity investments. An agent needs knowledge of the many other types of investments to compare the features, risks and benefits of each investment that best suits the needs of his clients. An agent also attains a better understanding of segregated funds through gaining a better understanding of the other types of investments available. The following information is categorized for each type of investment in this section. Advantages and disadvantages. Where and how to buy. Subcategories of the investment, if any. Returns and guarantees. Risks of investing, and investor protection. Segregated funds. Segregated funds, also called individual variable insurance contracts, IVICs or IVICs, and SC funds, are created by insurance companies and approved by regulators. The inception date of a fund is the date on which it can first be offered to investors. The assets in segregated funds are kept separate, or segregated, from other assets of the insurer. Insurers are required, by law, to set aside financial reserves so they can meet their contractual obligations for maturity and death benefit guarantees. Many types of segregated funds are available, to suit different investment objectives. With a segregated fund, investors deposit their savings to the fund, or funds, of their choice. The deposits create a pool of money, which is used by the segregated fund manager to acquire investments according to the type of fund they manage. For example, deposits to a bond fund are used by the segregated fund manager to buy a wide range of bonds. Segregated funds can be held in registered and non-registered accounts. Segregated fund investors may face a sales fee when they invest. This charge is paid once. It may be charged upfront as a front-end load, FEL, as a percentage of the sum invested. Or the sales fee may decline over years, called a deferred sales charge, until it is eliminated. It is charged as the percentage of the amount withdrawn if a partial or total withdrawal is made from the fund. Investors also pay an annual fee called the management expense. More information is provided on fees later in this module. Advantages and disadvantages of segregated funds. As a fund type investment, segregated funds share some characteristics with other fund investments, such as mutual funds. Segregated funds provide some unique features and benefits due to the fact that they are an insurance product and delivered through an insurance contract. These include possible creditor protection to their policy owner. Beneficiaries are named. Probate is bypassed. Guarantees provide a benefit on death and at contract maturity. Reset options. Tax benefit when capital losses are incurred, and assures protection against insolvency of the insurer. Some of the advantages segregated funds share with other fund investments are: there are a variety of funds. Ease of investment. Information readily available on funds before and after purchase. Diversification provided. Managed professionally. Provides liquidity. Ease of switching between funds. Ease of redemption, and ability to create an income stream from account value. Segregated fund disadvantages include a minimum 10-year term to maturity for the investment contract, higher annual fees than other fund investments, and possible age restrictions to entering a contract and deposits. Some disadvantages segregated funds share with other fund investments are too many choices of funds and often little differentiation between choices, and sales charges and ongoing fees charged as the MER. Where and how to buy segregated funds. Only those who are life licensed can sell segregated funds. Some segregated funds are sold by investment dealers, but in that case, the dealers are acting as agents for the life insurers only. A segregated fund investor acquires information about a segregated fund from his agent and an information folder provided by the insurer offering the fund. Completes the application, usually with the assistance of the agent, and receives the contract, provides a deposit, and signs the contract. The contract is issued with a 10-year term to maturity. Types of segregated funds. Many types of segregated funds are on offer. To create segregated funds, fund managers may concentrate their investments in asset classes, described previously, alone or in combination. When assets are combined in one fund, a balanced fund is created. Countries or geographical areas. Other segregated funds. These are called funds of funds. All fund types are not created equal. For example, each fund that exclusively invests in equities will hold shares of different companies. When funds hold the shares of the same companies, the amount of shares held by each fund will differ. The reason so many types of funds are available is to provide a choice among levels of risk and rates of return. Returns and guarantees of segregated funds. The word return has two separate meanings. Return describes performance. When return is used in this way, it is stated as a percentage. That percentage is a measure of how the value has changed, up or down, since the return was last reported. The percentage is arrived at by comparing growth against last reported value, and The returns for segregated funds are posted monthly, every 3 months, year to date, 1 year, 2 years, 5 years, 10 years, and since inception. Example. Phil receives a statement about his segregated fund that shows his contract has a value of $10,000. The next statement shows his contract has a value of $11,000. Therefore, his return for the period has been 10% or 1,000 divided by 10,000. Return describes the form in which growth is earned. Note, these are described previously as interest, dividends, and capital gains. Segregated funds can earn interest, dividends, and capital gains, which are reinvested in the fund as they are earned. Registered account owners, that is, RRSP accounts, do not report returns on their annual income tax. When they eventually withdraw money from the registered account, it is taxed as interest, regardless of how it was actually earned, such as capital gains. This is true of all types of investments and taxable registered accounts. Tax-free savings accounts are an exception because they're not a taxable account, and non-registered account owners receive the returns in the form they are earned, for example as a capital gain, and report them in that form for income tax each year. There are 2 guarantees provided by segregated funds. Maturity guarantee. This guarantees the investor will receive a minimum of 75% of his investment when the contract matures. If the market value is higher than 75%, the investor receives the market value. Death benefit guarantee. This guarantees the beneficiary of the contract will receive a minimum of 75% of the sum invested in the contract if the life insured dies while the contract is in force. If the market value is higher than 75%, the beneficiary receives the market value. Example 1. June invests $10,000 in her segregated fund contract with a 75% maturity guarantee. When the contract matures, she will receive $7,500 or $10,000 times 75%, or the market value if it is higher than $7,500. Example 2. Dane invests $10,000 in his segregated fund contract with a 75% death benefit guarantee. When he dies in year 7 of the contract, it is worth $6,250. His beneficiary receives $7,500. Together these guarantees limit losses. The investor knows that the maximum amount of loss they can experience is the difference between the sum invested and the guarantee amount. Risks of investing in segregated funds. While the death benefit guarantee applies throughout the contract, the maturity guarantee applies only at maturity. Therefore, if the policy owner needed to terminate his policy before maturity, they would receive its market value only. This could be less or more than the sum invested. The maturity guarantee may leave a non-guaranteed 25% gap between sum invested and sum guaranteed. This has the potential to deliver a 25% loss on the investment. The investor must commit to the full 10-year contract to receive the maturity guarantee. Investor protection. Assurance is an organization that provides policyholder protection up to certain limits, against the insolvency or bankruptcy of the insurer that holds investor deposits in its segregated funds. Guaranteed investments plus segregated funds and annuities provide protection against market losses. Non-guaranteed investments can fall to zero value in the market and there is no recourse or protection available against market losses. Annuities. An annuity is structured to repay a regular income over time. They are easy to understand, highly secure, widely available, and investor protected. An annuity contract is set up between the insurer and the investor. The investor names the annuitant, the person who receives the income payments. The annuitant may also be known as the annuitant grantee or payee. The wording of different parties to a contract may differ from contract to contract. For this reason, it is very important to understand the definitions of an annuity contract. An interest rate is assigned by the provider and the payments made to the annuitant are a combination of the investor's principal plus interest. The amount received by the annuitant is called an annuity payment. An annuity payment is usually set or fixed for its term, changing interest rates have no effect. The contract is assigned an annuity rate, which determines how much income will be paid to the annuitant. Many factors contribute to the annuity rate. The primary factor is the interest rate in effect at the time that the annuity is purchased. Other factors that may affect the annuity payments include the age and gender of the annuitant, and the amount of money deposited to the annuity contract. Annuity rates vary between providers. Annuities can be either fixed, payments are guaranteed and will be received for the duration of the annuity, or not fixed, payments are guaranteed at a minimum rate, they are variable and tied to the stock market, or indexed and tied to the rate of inflation. There are two main types of annuities. Payout annuities. All annuities that pay an income are classified as payout annuities. This is what most people are referring to when an annuity is mentioned. And accumulation annuities, in which savings accumulate over the term of the annuity to produce investment growth. On maturity, the investor has the choice of converting the accumulation annuity to a payout annuity. Note, this module centers on payout annuities except for a brief description of accumulation annuities in Chapter 3. Advantages and disadvantages of annuities. The primary advantage of annuities is their guaranteed income stream, paid for the duration of the annuity contract, typically the lifetime of the annuitant. Investment management is taken from the hands of the investor. This simplifies annuity investment and makes annuities a good choice for investors who do not have investing expertise. Annuities that are prescribed may offer some tax advantages, meaning less tax is payable in the early years of the contract. Investor protection is available for insurance annuity contracts through assurance. The primary disadvantages of annuities are their lack of flexibility and interest rate risk. When annuity payments begin, no changes can be made to the contract. The investor will face penalties to make a withdrawal. The interest rate is set in the contract. If interest rates rise, the annuity payment would increase. If the annuity was purchased when higher rates were in effect, they will not be applied to an existing contract. The higher rate would only apply to contracts issued while that rate is in effect. Where and how to buy annuities. Life insurers provide single life and joint annuities. Life insurers and other financial institutions provide term annuities. An annuity contract can be held in a registered or non-registered account. Types of annuities. The generic types of annuities are the following. A term annuity, also called a term certain annuity. Payments are made over a specified period of time, the term. A life annuity, payments are made for the lifetime of the annuitant, and a joint annuity, also called a joint and last survivor annuity, 2 lives are covered. Payment is made to one annuitant and on the death of that annuitant, payment is then made for the lifetime of the other annuitant. Note that insurance companies adopt these generic names for marketing purposes. Return and guarantees of annuities. The return on the annuity, that is, its payment, is guaranteed unless the annuity is variable. Payments are tied to the stock market, and annuity payments can increase if the stock market performs well, or indexed. Payments are tied to the rate of inflation, and can increase if inflation rises. Risks of investing in annuities. As noted above, the interest rate is set in the contract and there is no opportunity to change if interest rates go up. Another risk is introduced because the set interest rate also sets income. For an annuitant who does not have an indexed annuity, inflation risk may be experienced, in which costs of living increase over time but income stays the same. Inflation risk creates a loss of purchasing power for those on a set, or fixed, income. The longer the term of the annuity, the greater the impact of inflation. Investor protection. As noted, assurance protects investors through its coverage for annuity owners. All annuity contracts sold by insurers will be assurance covered. Stocks. Stocks are also called shares or equities. They represent ownership in a corporation, whether that corporation is privately owned or publicly traded. Many indicators are used to predict whether stock prices will rise or fall. They may be macroeconomic, for example, based on the economic conditions of a region or country. Or they may be microeconomic, for example, based on a single product developed by a company. Stock values also rise and fall according to investor sentiment. Despite all the indicators available, no one knows for certain what will happen to the price of a stock. For this reason, they are considered risky investments. Some companies issue stock dividends to their shareowners, some do not. There is no absolute guarantee that dividends will be paid, and preferred shareowners receive dividends before common shareowners. The following types of segregated funds include stocks, equity funds, balanced funds, and growth funds. Advantages and disadvantages of stocks. Why buy stocks? Stock advantages. The primary advantage of stock ownership is participation in an increase in the value of the stock. This increase is a capital gain, and There is high transparency in the stock market investing as stock prices are available in the stock market. Stocks are also quickly and easily sold, though not necessarily at the value desired by the investor. Stock disadvantages. The primary disadvantage of stock ownership is the uncertainty of a positive outcome. It is possible to lose everything you have invested. Losses in the value of the stock are partially compensated by the capital loss received by the investor, who can use that loss to offset taxable capital gains. There are commissions charged on every trade. No naming a beneficiary to the account. Possible lack of diversification that exposes the investor to risk. No ability to rescind a sale, and liquidity issues if stocks have to be sold at a time when the price is low, but the investor needs money. Where and how to buy stocks. Publicly traded stocks are traded on stock exchanges. To buy stocks, an investor needs an account with an investment dealer that provides trading services, buying and selling, or a discount broker. An investor pays a commission, on buying and selling, to the advisor who is registered to sell securities. Know your client, KYC, requirements have to be satisfied so that the sales representative is satisfied that the investment is within the financial capacity and risk tolerance of the investor. Stocks can be held in self-directed registered accounts and in non-registered accounts. Returns and guarantees of stocks. Stock returns are provided in the form of capital gains and capital losses, and dividends. There are no guarantees of positive returns. Risks of investing in stocks. An investor in stock can experience market risk, industry risk, and the risk of loss of principal invested. Although as an asset class stocks are high risk, not all stocks are created equal. There is a range of risks that put blue chip stocks at the least risky end of the spectrum and highly speculative ventures, represented by penny stocks, at the other end. Currency risk can diminish returns if an investment is made in foreign firms. Investor protection. Investors are protected against the bankruptcy of an investment dealer through the Canadian Investor Protection Fund, CIPF. There is no investor protection against losses in stock value. Bonds. Bonds are also called a debt investment, as they represent a debt between a borrower, who is the issuer, and a lender, who is the investor. Bonds are also called a fixed income security. Many segregated funds focus on bonds or include bonds as part of their portfolio. Therefore, it is important for life agents to understand how bonds work. A bond is registered electronically when it is purchased. It consists of a face amount, the principal invested, and a coupon rate, which represents the interest paid by the bond. A bond is like an IOU of a corporation or government. The investor loans the corporation or government money and receives the bond, IOU, in return. Bonds are issued with a maturity date, as long as 30 years. During this period, the corporation or government compensates the investor for the use of invested money by paying interest to the investor. Bonds can be sold by their owners before maturity, or the date upon which the entire balance of the bond becomes due and must be repaid to the investor. An active market exists for buying and selling bonds. Bonds can be held in self-directed registered accounts and non-registered accounts. Bonds can both preserve and increase capital and can provide a predictable stream of payments in the form of coupon or interest payments. Advantages and disadvantages of bonds. Why buy bonds? Bonds provide an income stream via their interest payments. They can also increase in value. The bond market is vast, much larger than the stock market. This gives investors a wide range of bonds to choose from, and correspondingly, bonds are available across the risk spectrum. Investors choose among credit ratings, issuers, terms to maturity, and coupon rates to build a diversified portfolio aiming to get higher returns while reducing overall risk, and to maintain investor confidence. Repayment of the face amount and interest payments are virtually guaranteed for government bonds. There is a slightly greater chance that corporate bond payments will not be made. A disadvantage of bonds is that an investor must seek them out through a securities advisor, and little information is provided about price. This lack of transparency may mean that buyers overpay for a bond. Where and how to buy bonds. Bonds can be purchased from those with the proper registration for bond sales. These advisors are either licensed by IIROC or limited market dealers through the Mutual Fund Dealers Association, MFDA. Many financial advisors and financial planners did not have direct access to bonds as their license does not permit them to offer these types of securities. Types of bonds. As noted previously, bonds fall into two general categories: government issued or corporate issued. However, bond issuers from other countries may issue bonds in Canada, in Canadian dollars. These are known as foreign bonds. A Eurobond is another type of bond. It is issued by a foreign country in its currency for sale in other countries, such as bonds issued by the US in US dollars for sale in Japan. Government of Canada bond characteristics. Highest credit rating of all Canadian government bonds. Issued in the name of the Government of Canada and Federal Crown Corporations. Terms from 1 year to 30 years. Start at $5,000, and fixed interest, paid semi-annually. Provincial government bond characteristics. Next highest to Government of Canada bonds in credit rating. Issued by the provinces and provincial agencies, and guaranteed payment of principal plus interest at maturity. Municipal bond characteristics. Small percentage of Canadian bond market. Lowest credit rating of all Canadian government-issued bonds, and credit rating depends on the creditworthiness of the municipality that has issued the bond. Corporate bond characteristics. Issued by companies looking to expand their operations, and risk is based on creditworthiness of the corporation issuing the bond. Foreign bonds characteristics. Governments of other countries and multinational companies may also issue bonds, and their creditworthiness is a result of the political and economic stability of the issuer. Returns and guarantees of bonds. Before maturity, interest payments are made by the bond issuer, usually twice a year. Interest may be fixed, floating, or payable at maturity. On maturity, the face amount of the bond is repaid with any outstanding interest obligations. The amount paid is a result of the following factors. Maturity date. Bonds are issued as short-term, 3 years or less to maturity, medium-term, 3 years to 10 years to maturity, or long-term, 10 years or more. The longer the term, the higher the interest rate on the bond. Credit quality. Bonds are rated according to the likelihood of repayment of face amount and payment of principal. The highest rated bonds are AAA, the lowest are junk bonds. These bonds are typically rated as B or lower, and price. Bonds are issued at their face value, called par value. Interest rate changes will change the price of the bond in the bond market. Selling a bond above its face amount, at a premium, creates a capital gain. Selling below face value, at a discount, produces a capital loss. Risks of investing in bonds. The risks associated with investing in bonds include interest rate risk, reinvestment, credit, liquidity and inflation risk. Currency risk can affect returns on foreign bonds. These forms of risk are discussed later in this module. Investor protection. A bond is a type of security. Therefore, investor protection against the bankruptcy of an investment dealer is provided in the same way as it is for a stock, another type of security, through the Canadian Investor Protection Fund. The CIFP protects accounts held by its members up to specified limits if the dealer becomes insolvent. Savings accounts. A savings account is an account at a financial institution that accepts deposits and pays interest, usually at a very low rate. Savings accounts are easy to open, and money can be easily deposited and withdrawn. Checking privileges may be absent or restricted. Advantages and disadvantages of savings accounts. Savings accounts offer convenience and liquidity unlike any other type of investment. Savings accounts offer a low interest rate and there is often no amount needed to open an account or keep one. The penalty paid by investors for these advantages is their low nominal interest rate. Investors will quickly find their savings are subject to inflation risk since the inflation rate could exceed the interest rate on the account. Their purchasing power will be eroded, and more so as time passes. When the real rate of return is calculated on a savings account, it is quite possible for the investor to incur consistent negative returns. Savings accounts are best used for the short term as a place to park principal while investment decisions are being made. Types of savings account. Traditional savings accounts offer a low interest rate, low fees, and no withdrawal restrictions. High-interest savings accounts offer slightly higher interest rates, but there may be a restriction on withdrawal privileges, or other restrictions. Returns and guarantees of savings accounts. Returns on savings accounts are in the form of interest. Interest is paid on the account balance. Guarantees on savings accounts are largely backed by the size and strength of the financial institution providing the account. Risks of holding savings in a saving account. Inflation risk is experienced and increases the longer savings are held in the account because inflation compounds year over year. Recall that inflation is expressed by the real rate of return on an investment. Example. Ethel has $10,000 in her savings account that paid 1.5% annual interest last year. The inflation rate for the year was 2.8%. Therefore, Ethel's real rate of return was minus 1.3%. Investor protection. Provided by Canada Deposit Insurance Corporation to its members for up to $100,000 per account. Guaranteed Investment Certificates (GICs). A GIC is a form of deposit to a financial institution in which there is a term to maturity before principal will be repaid. Interest is received by the investor. GICs can be held in registered accounts and non-registered accounts. Advantages and disadvantages of GICs. Investors use GICs for their guaranteed return of principal and interest as promised. Variety of products available to give investors choice. Available for as little as $500 and no out-of-pocket fees, and convenient, easy to understand, and easy to buy. The disadvantages of GICs are the low rate of return, and their illiquidity. Early withdrawals are significantly penalized. The cashable or redeemable GIC is a way to get around the liquidity issue, but at the cost of lower interest rates. Where and how to buy GICs. Available through financial institutions including banks, trust companies, credit unions, insurance companies, investment dealers, and specialized GIC deposit brokers. An application with deposit is made to complete the transaction. Types of GICs. Fixed interest GICs pay interest at the nominal, or posted, rate. May earn simple interest that is paid annually or compound interest that is paid at maturity. Even if the interest is not paid in any 1 year to the investor, the interest earned needs to be declared for income tax purposes. Cashable or redeemable GICs allows the investor to be released from the GIC before the end of its term. Interest rate is lower than when the investor is locked in for a term. Escalating GICs increases the interest rate on its anniversary, or permits a withdrawal on the anniversary. Variable interest GICs keep their interest payment in pace with general interest rates. Market-linked GICs links some of its return to a market index, such as the S&P TSX Composite Index. The total return from the GIC has an upper limit. Generally not cashable or redeemable. Insurance GICs are also called accumulation annuities. They are exclusively offered by insurance companies and offer benefits based on its issue as an insurance contract, such as bypass of probate and creditor protection. Returns and guarantees on GICs. Principal and interest are guaranteed to be paid at maturity. Their returns are in the form of interest. Risks of investing in GICs. The GIC investor faces interest rate risk and inflation risk, which are discussed later in this module. Investor protection. Investors are protected by the Canada Deposit Insurance Corporation, CDIC, but only if the term to maturity is 5 years or less. The deposit is in Canadian dollars, and the principal deposit is no greater than $100,000. Insurance GICs are protected by Assurus, the organization that provides investor protection to Canadian life insurance policy owners. Mutual funds. Mutual funds are created in two forms. An open-end fund issues units to its investors in proportion to the amount they have invested. A closed-end fund has a fixed number of shares, which it issues to its investors. Closed-end funds are not described in this module. The open-end mutual funds pool the deposits of investors. Just like with segregated funds, the mutual fund manager uses the pool of money to acquire investments according to the type of fund they manage. For example, money deposited to a bond fund is used by the mutual fund manager to buy a wide range of bonds. There are a huge number of mutual funds from which to choose. Mutual funds investors did not commit to a term for their investment. They may redeem their investment at any time and receive proceeds shortly after that. There are many similarities between segregated funds and mutual funds. One is their type of fees. A sales fee upon purchase, called a front-end load, or on a declining basis and paid when units of the fund are sold, called a back-end load or a deferred sales charge, DSC. The annual management expense fee, expressed as a ratio, the management expense ratio or MER, and paid to compensate the managers of the fund. Another similarity between segregated funds and mutual funds is their use of professional investment managers who decide what investments to make within the type of fund they are managing, when to buy and sell those investments, monitor diversification, allocation of assets, and performance. Mutual funds can be held in registered accounts and non-registered accounts. Advantages and disadvantages of mutual funds. What advantages are specific to mutual funds, and not shared with segregated funds? The primary advantage of mutual funds compared to segregated funds is the lack of a 10-year term to maturity. This means an investor can easily enter and exit the investment without any penalty other than what must be paid as a sales charge. Mutual funds also permit their investors to withdraw money regularly. This can create an income stream for the investor, who can set up a systematic withdrawal plan to provide a regular stream of income from the fund. Mutual funds are also offered in the retail environment of banks, cases populaires, and credit unions, which is a convenience factor not available to segregated fund investors. Some of the disadvantages of which investors should be aware are: mutual funds are not intended to be a short-term investment. Tax complexities require investors to monitor fund activity. Trailing commissions, or trailer fees, also called service fees, are paid annually by the fund manager to sales agents. They are generally higher for funds sold with a front-end load, and for equity and balanced funds. The fee is a percentage, usually 0.25% to 1%, charged against the market value of the customer's total assets. A MER is charged by mutual funds for professional management services of the fund. This fee can erode returns significantly. The MER is calculated by annual operating expenses, which vary widely depending on the fund type, divided by the average dollar value of assets under administration. Client Relationship Management 2, CRM2. This is a recent innovation in mutual funds with regard to new rules for disclosure to clients. Mutual funds are now required to provide additional written communication to clients, an annual report on costs and fees, and an annual report on performance. This is intended to ensure investors thoroughly and accurately understand their fund investment. Where and how to buy mutual funds. Mutual funds are widely available. The investor completes a form to open an account. The advisor completes a Know Your Client form based on the investor's goals and information to determine investment objectives and create an investor profile. The investor and advisor together choose a suitable fund, and the investor receives a simplified prospectus that discloses the material facts about the fund that could have an impact on the value of the fund. For example, the fund could be an ethical fund. The simplified prospectus could reveal that the fund will not invest in tobacco products. Within 2 days of purchase, the investor must receive a fund facts document, which is intended to be an easy-to-read overview of the selected fund with key details, such as performance data and the management expense ratio, MER. Fund units can be bought and sold anytime at market value. The unit value of money market funds is fixed. Types of mutual funds. Mutual funds are available in the same categories as segregated funds. Cash including funds in the money market. Fixed income, for example, bonds. Equity, for example, stocks. Commodity, for example, oil, and other. Funds may also be categorized by a region in which investment is based, or whether the market is developed or emerging. Fund types are detailed in Chapter 2. Returns and guarantees of mutual funds. Mutual fund returns are not guaranteed. The return is determined based on the net asset value, NAV, of the fund. It is expressed as a percentage. The NAV per unit is the total net asset value of the fund divided by the number of outstanding units. For accuracy, returns should only be compared between similar funds, that is, equity to equity, and over at least the most recent 5-year period to get a better picture of performance over the longer term. Distributions are a combination of earnings generated by securities within the fund and capital gains resulting from buying and selling those securities. Non-registered account owners may receive their distributions in cash or reinvest them in the fund. Risks of investing in mutual funds. Without guarantees, investors risk total loss of their investment. Otherwise, risk depends on the type of fund. For example, cash-based funds face interest rate and inflation risk. Equity-based funds face market risk and industry risk. Fixed income funds face interest rate risk, and currency risk can be experienced by funds in which there is foreign investment. Investor protection. Like stocks, there is no protection against market losses in mutual funds. Both the Canadian Investor Protection Fund, CIPF, and the Investor Protection Corporation of the Mutual Fund Dealers Association cover investors for up to $1 million in general accounts against the bankruptcy of investment dealers. Exchange-traded funds, ETFs. ETFs are funds that track indexes, like the Toronto Stock Exchange. Investors buy shares in the funds that trade exactly like stocks. This includes paying a commission on buying and selling. They are considered a passive form of investment since they simply follow the lead set by the index on which they are based. For this reason, they charge lower management fees than mutual funds or segregated funds. More recently, some ETFs have been launched that attempt to better the return achieved from following the index. This is an active style of investing, and these products have higher MERs. Advantages and disadvantages of ETFs. ETFs offer advantages that include diversification, ease of trading, lower management fees than other funds, no penalties, ability to react rapidly to market developments and speculation on short-term price, ability for advanced trading transactions such as limit, stop loss, margin and short sale orders, options, and sector rotation. ETFs have distinct disadvantages that include they are not suitable for a novice or unknowledgeable investor. ETFs are complex and successful ETF investing requires an understanding of indexing and how the stock markets work. Trading fees, commissions on buy and sell orders. Low liquidity for infrequently traded ETFs or ETFs not traded in high volumes. Where and how to buy ETFs. The investor needs an account with a securities dealer. ETFs are sold by prospectus. The investor will receive a prospectus on which to base any buying decision. Types of ETFs. Many types of ETFs are available that track currencies, industries, style, such as growth, value or market capitalization, bonds, dividends or real estate in Canada or abroad, and there are also other, more exotic ETFs such as inverse ETFs, which moves in the opposite direction of an associated exchange or index. An ETF may be structured as a mirror image of an index or sample. Returns and guarantees of ETFs. As with stocks, ETF returns are not guaranteed. Returns are earned as interest, dividends, or capital gains. Risks of investing in ETFs. The risk of the ETF is similar to the risk of its underlying index. Thus, ETFs have market risk and may have industry risk, currency risk, and liquidity risk. Investor protection. Like stocks and mutual funds, there is no protection against market losses. The Canadian Investor Protection Fund, CIPF, protects against the insolvency of the security dealer for accounts held by its members to specified limits. Real estate. Real estate for savings and investment purposes is the type that generates income through rent or mortgages. Advantages and disadvantages of real estate. Real estate diversifies a portfolio. Its primary advantages are the regular income it produces, the equity that builds in the property from mortgage payments, and ultimately the capital gain received when the property is sold for more than its cost. The primary disadvantages are the large sum needed to begin, including the payment for the land or property, commissions charged on real estate sales and property taxes, as many as tens of thousands of dollars are typically required for a down payment, and liquidity risk, as real estate can be difficult to sell quickly. Real estate investors can also be exposed to interest rate risk if mortgage rates rise, and to market risk, when the overall market for real estate declines. Types of investment real estate. Investment real estate encompasses homes, condos, apartment buildings, single and multifamily homes. Commercial property, typically used for service businesses, such as restaurants. Industrial property, typically used for industrial purposes, such as manufacturing, and land for future development. Returns and guarantees of real estate. There are no guarantees to real estate investors that rents will be paid or property values will increase. Returns are in the forms of rent, tax-like interest, and capital gains, or loss, at the time of sale. Risks of investing in real estate. Significant liquidity risk, as properties are often not sold quickly at their asking price. Real estate that is mortgaged is also subject to interest rate risk, which affects the rate charged on the mortgage. Market risk, which occurs when the real estate market declines overall. Investor protection. There is no investor protection for real estate investors. Canada Premium Bonds, CPBs, and Canada Savings Bonds, CSBs. These are bonds issued to small investors by the Government of Canada. CPBs are bought from the government or financial institutions. CSBs are bought only through an employer's payroll savings plan, and CPBs pay a higher rate of interest than CSBs. They are a debt form of investment with a term to maturity. Advantages and disadvantages of CPBs and CSBs. These bonds are one of the safest, least risky investments available. They can be cashed at any time. CPBs are available in denominations as low as $100. CSBs have no fixed denominations and contributions can be as low as $2 per week. CSBs provide employers with the ability to offer a valuable employee benefit. The bond contribution is automatically deducted from salary or wages. The disadvantage of these bonds are their very low interest rate, and no interest is paid within 3 months of purchase for the month in which the bond is redeemed, and if a CPB is redeemed before its maturity date, interest is paid only to the last anniversary date of issue. Where and how to buy CPBs and CSBs. CPBs are sold through the government and financial institutions starting each October and for 2 months after. CSBs are sold each year in October. Returns and guarantees of CPBs and CSBs. Pays regular or compound interest. Regular interest bond pays its interest annually, and compound interest bond reinvests its interest annually. The guarantee for repayment of principal and interest is provided by the Government of Canada. Risks of investing in CPBs and CSBs. Investors face interest rate risk and inflation risk. Group plans. Group savings plans are provided to employees, associations, and to people who are members of associations and fraternal organizations. The choice of investments, if any, is provided by the sponsor of the plan, for example, the employer. Advantages and disadvantages of group plans. The members of a group plan receive assistance and encouragement to join their plan. In the case of employer-sponsored plans, the foremost advantages of joining are to receive the employer's contribution to the individual plan. Forced savings. For employer-sponsored plans, contributions are taken directly from gross income and, depending on the type of plan, are not subject to payroll taxes. Contributions made by an employer to a deferred profit-sharing plan, DPSP, are fully tax-deductible to the employer and not subject to payroll taxes. Contributions made by an employer to a defined contribution pension plan or defined benefit pension plans are fully tax-deductible to the employer. Account fees are paid by the sponsor, in this case, the employer, to get better potential rates of return than can be achieved in an individual plan. To access to many investment tools and opportunities. To receive an account or pension statement every year. The disadvantages to members can be restricted investment choices and the inability to control plan changes made by the employer. The group plan administrator enjoys separate advantages, primarily a significant employee benefit that can be used to attract top talent to the company. Range of plans available tailored to the objectives and financial capability of the employer. Tax deductibility of some of its contributions. Contributions made by an employer to a deferred profit-sharing plan, DPSP, are fully tax-deductible to the employer and are not subject to payroll tax. Contributions made by an employer to a defined contribution pension plan, DCPP, or a defined benefit pension plan, DBPP, are fully tax-deductible to the employer. The ability to change the plan at will. The main disadvantage to the sponsor of a defined benefit plan, DBP, is its obligation to provide a promised retirement pension to members. This obligation is not present for defined contribution plans, which assist the employee in building a pool of savings for retirement but do not promise any specific benefit in retirement. Also, Group Registered Retirement Savings Plan, GRRSPs, contributions are subject to payroll tax. Where and how to buy a group plan. Group plans are marketed to sponsors by life insurance agents based on their needs and financial capacity. The group administrator coordinates a plan between the plan provider and plan members. Types of group plans. Details on these plans follow later in this module. Plan overview. Defined benefit plans, unique because it is the only plan that pays an income during retirement that is known, that is, defined, in advance to the group member. Defined contribution plans, also known as the money purchase plan, the income paid during retirement is not known in advance because it is a result of member contributions and investment choices. Group registered retirement savings plans, an RRSP for groups. Each member's income at retirement will be based on contributions and investment choices. Deferred profit sharing plan. Profits of the employer are shared with employees to form plan contributions. Each member's income at retirement will be based on contributions and investment choices. Tax-free savings account, a TFSA for groups to provide tax-free income. Each member's income at retirement will be based on contributions and investment choices. Pooled registered pension plans, a plan for small business employees and the self-employed to save for retirement. Each member's income at retirement will be based on contributions and investment choices. Note that PRPP legislation varies from province to province. Returns and guarantees of group plans. Payments received from a group plan are taxed like interest income. A defined benefit pension plan, DBPP, offers a guaranteed income in retirement but only if the plan is fully funded. When there is a shortfall, pensioners can receive less than the promised pension. Some jurisdictions provide a guaranteed minimum income to pensioners to cover shortfalls. For example, in Ontario, pensions up to $1,000 per month are insured by the Pension Benefits Guarantee Fund. Risks in offering a group plan. An employer commits to contribute to the plan and the costs of administration. Business conditions may worsen and funding the plan may be difficult, creating a shortfall. Risks in participating in a group plan. When a group plan member has to make investment decisions, as in a defined contribution pension plan, DCPP, or a group registered retirement savings plan, GRRSP, they will have to deal with investment risks such as interest rate risk, inflation risk, and market risk. Plan member protection. Provinces and territories administer pensions through their financial institutions commissions or the government ministry responsible for the Pension Benefits Act in their jurisdiction. These acts protect the rights and benefits of plan members. 1.4. Risks of investing. Investing carries many risks. The individual has control over some risks and no control over others. Economy as a whole. An investment can be affected by macroeconomic factors, which affect an economy as a whole. This is economic risk, which also includes political and legal risk. Economic risk factors include regional, national and global factors, for example, change in government regulation, political upheaval. Inflation risk. Inflation risk is also known as purchasing power risk. Inflation is an increase in the cost of goods and services as measured by the Consumer Price Index, CPI. To calculate the real rate of return of an investment, inflation has to be factored in. When the rate of return is lower than the rate of inflation, the investor suffers a loss in purchasing power. This means that the same amount of cash will be able to purchase fewer goods in the future due to the higher prices. Inflation compounds year over year as prices are inflated over already inflated prices. This makes long-term investments especially vulnerable to inflation risk. The following are examples of investments that can experience inflation risk. Cash and cash equivalents such as a money market fund. Investments with guaranteed returns such as GICs and bonds. Fixed annuities. Segregated funds that invest in money market funds and bonds. To avoid or decrease inflation risk, the return on an investment must be at a minimum equal to the rate of inflation. Thus, the investor's funds increase in proportion to inflation. Example. Assume that the average rate of return on a 1-year guaranteed investment certificate, GIC, on sale today is 1.39%. The inflation rate for the last year is 1.20%. Therefore, if we assume the inflation rate will be the same for the next year, the real rate of return on the GIC is 0.19%, 1.39% minus 1.20%. The GIC is barely keeping ahead of inflation. Interest rate risk. If an investment that pays interest is locked into a fixed interest rate, then an investor cannot take advantage of higher interest rates if interest rates increase. This is interest rate risk, inherent in all investments that pay fixed rates of interest. Interest rate risk occurs in bond pricing. The market value of a bond is less when interest rates rise. As interest rates rise, bond prices decline, and as interest rates fall, bond prices go up. Example. Assume that the interest on a 3-year GIC is 2.20%. Interest rates increase to 2.40% 9 months after the GIC is purchased. The investor cannot benefit from the rise in interest rates. He is tied to the lowest rate for the balance of the term. Market risk. Market risk is the risk of a downturn in the total financial market. An economic recession, a major natural disaster, or terrorist attack are all examples of events that can trigger market risk. A diversified portfolio may not protect an investor as market risk could affect many or all asset classes. Example. The financial crisis that began in 2007 was an example of market risk. The events that started that year and continued through to the end of 2008 caused all asset classes to decline. Massive government intervention was needed to prevent a total economic collapse. In 2007, many U.S. homeowners owed more on mortgages than their properties were worth. This led to many foreclosures on residential real estate in the U.S. People simply walked away from their houses and mortgages, leaving the financial institutions holding those mortgages without incoming mortgage payments. This event became known as the subprime mortgage crisis. Real estate as an asset class was seriously negatively impacted. The loss of mortgage payments by financial institutions also affected the entire financial system because many investment dealers and banks had created financial products based on subprime mortgages. In September 2008, the U.S. Congress rejected a $700 billion Wall Street financial rescue package for the financial services firms affected by the subprime mortgage crisis. This sent the Dow Jones Industrial Average down 778 points, its single worst point drop ever. Thus, equities were affected as an asset class. Most investors felt some degree of impact from this crisis. Liquidity risk. Liquidity risk is the risk that an investment cannot be easily converted into cash, or that an investment cannot be sold without affecting the value of the asset or investment. Real estate is an asset with liquidity risk. Annuities have liquidity risk. They may be surrendered, but withdrawal penalties and market value adjustments will drop the value of the investment. Foreign exchange risk. Foreign exchange risk is also known as currency risk. This is the risk created by currency fluctuations when the price of one currency changes relative to another. Investors or companies with assets or business operations in foreign countries are subject to foreign exchange risk. Investment funds that invest in foreign countries face this form of risk. Credit risk. Credit risk is also known as default risk. It is the risk that a borrower will fail to repay a loan or other financial obligation. Credit risk is particularly relevant to bond issuers. Bonds, such as the Government of Canada, are of the highest credit quality and have low credit risk. Junk bonds have low credit quality, and the credit risk is very high. Firms such as Moody's rate credit quality. A top rating of AAA is given for insurance companies that offer exceptional financial security. C is the lowest rate. Insurance companies with a C rating has very poor prospects of offering financial security. Industry risk. Industry risk is the risk faced by specific industries. For example, the retail sector could face lack of consumer interest in products, inability to control costs, supply chain disruptions and supplier problems. Investments focused on investing in specific industries, which can include mutual funds, may experience industry risk. Other investing risks. Many risks, both general and specific, are associated with investing. To determine if these risks fall within investor risk tolerance, agents and investors must understand the risks associated with investment. Chapter 2, Segregated Funds. 2.1. Advantages of segregated funds. The many advantages of segregated funds include the following. Guarantees. Growth secured by reset. Funding flexibility. Guaranteed income. Professional management. Diversification. Tax benefits. Switches between funds. Ability to withdraw funds. Exemption from probate fees. Investor protection. Creditor protection. Absence of medical underwriting, and right of rescission. These benefits will be discussed in the following pages. Guarantees. Segregated funds provide two guarantees that protect the investor from losing money on their investment. A maturity guarantee, and A death benefit guarantee. The maturity guarantee is a minimum return to the investor of 75% of deposits providing the investor's contract is in force until its maturity date, usually 10 years from when it began. The death benefit guarantee is for the same minimum return, 75%, but it is in force for the entire length of the contract and is paid on the death of the policy owner or annuitant instead of at the end of the 10-year period. Note, the policy owner is the person who owns the contract and pays the premiums or deposit. The annuitant is the person on whose life the contract is based, that is, if the annuitant dies during the contract, the death benefit is paid. The annuitant and the policy owner may, or may not, be the same person. Some contracts are structured to offer 100% guarantees. Often these contracts are based on a longer term to maturity, such as 15 years. Maturity and death benefit guarantees are always stated with the maturity guarantee first, followed by the death benefit guarantee. For example, when they are equal, the guarantees are stated as 75%, 75%. When the maturity guarantee is less than the death benefit guarantee, the guarantees are stated as 75%, 100%. If the market value of the contract at maturity or death is less than the guarantee, the insurer makes up the difference so that its value is equal to the guarantee. The life insurance agent assists the client in choosing the contract that is most suitable for the investor's needs and objectives. Maturity guarantee. The maturity guarantee applies on the maturity date of the contract. The maturity date is usually 10 years, never less, from the time the first deposit, or premium, is paid to the insurer, although some contracts offer maturity dates longer than 10 years. Contracts with longer terms to maturity typically offer a guarantee higher than 75%. The maturity guarantee limits investment risk for the policyholder by establishing a minimum contract value at maturity, known as downside protection. There is no maximum to what the value may be. This is called unlimited upside potential. On maturity of the contract, the policy owner may withdraw the value of the investment. If the market value is greater than the guarantee value, the policy owner receives the market value. If the market value is less than the guarantee value, the policy owner receives the guarantee value. When the market value is less than the guarantee value, the insurer tops up the market value to equal the value of the maturity guarantee. Extend the contract and leave the investment in place. A top-up by the insurer is attributed to the account to bring its value up to the level of the maturity guarantee. If the contract is surrendered before the maturity date, it does not receive the benefit of maturity guarantees. The policy owner receives the market value of the units minus any sales charge that may apply. The market value of the units may be greater than, equal to or less than the value of the units when the deposit was made. There is no guarantee regarding their value. The maturity guarantee is reduced by withdrawals made during the term of the contract. The policy owner receives the market value of the units when the withdrawal is made, and if a withdrawal is made during the period that the sales charge applies, the applicable charges are deducted from the withdrawal. Table 2.1. Determining withdrawal value at maturity. Market value of contract at maturity. Higher than guarantee value. Amount received by policy owner. Market value. Market value of contract at maturity. Lower than guarantee value. Amount received by policy owner. Guarantee value. Example. Michael invests $10,000 in a segregated fund with a 75% maturity guarantee. The guarantee at maturity is $7,500, $10,000 times 75%. Scenario 1. At maturity, the fund has a market value of $8,360. This is greater than the maturity guarantee, and it is the sum Michael receives. Scenario 2. At maturity, the fund has a market value of $6,360. This is less than the maturity guarantee. Michael receives $7,500, which comprises the market value plus a guarantee top-up of $1,140, $7,500 minus $6,360. Scenario 3. After 4 years, Michael surrenders the contract. The fund has a market value of $7,120, and this is the sum Michael receives. Michael does not receive the benefit of the maturity guarantee because he has surrendered the contract before its maturity date. Death benefit guarantee. The death benefit guarantee is a near duplicate of the maturity guarantee. It applies throughout the entire term of the contract. If the annuitant dies during the contract, the beneficiary receives an amount that is equal to 75%, at least, of the initial deposit. The amount paid as the death benefit is the greater of the contract's market value or specified guarantee, 75% or 100%, just like the maturity guarantee. And, just like the maturity guarantee, if the market value is less than the guarantee, the insurer makes up the difference between the two amounts so that the guaranteed amount is received. There are 3 advantages to the death benefit guarantee. The beneficiary is protected from downside market risk throughout the term of the contract, just like the maturity guarantee protects the policy owner. The guarantee applies from day 1 of the contract and applies throughout the length of the contract, and, like the maturity guarantee, there is no limit to how much the beneficiary might receive, more than the guarantee, if market conditions are favorable and unit values are high at the time of death. Withdrawals made during the contract can reduce the amount received by the beneficiary because the sum on which the guarantee would have been based is adjusted downward by the withdrawal. The death benefit may also be reduced by a sales charge. Some insurers waive the charge when the contract ends due to death. The death benefit payment is tax-free to the beneficiary. Its value is further enhanced because it will not be subject to probate fees if there is a named beneficiary that is not the estate of the deceased. Example: Keith is the policy owner and annuitant of a segregated fund contract with a 75% death benefit guarantee. Keith funded the contract with a $10,000 bonus he received from his employer. The death benefit guarantee is, therefore, $7,500, $10,000 times 75%. His wife, Patricia, is the beneficiary of the contract. Keith dies during the 9th year of the contract. Scenario 1. At the time of Keith's death, the market value of the contract is $12,640. Patricia receives that amount since it is greater than the death benefit guarantee of $7,500. Scenario 2. At the time of Keith's death, the market value of the contract is $6,300, which is less than the guaranteed amount, $7,500. Patricia receives the death benefit guarantee of $7,500, which represents the market value of $6,300 plus a top-up of $1,200 or $7,500 minus $6,300. Growth secured by reset. Some insurers offer resets on their segregated funds. When it is offered, a reset allows the policy owner to take advantage of an increase in the market value of the fund. How does a reset work? As the market value of the fund increases, reset locks in this value at its higher sum. The maturity and death benefit guarantees are based on the new contract value. For example, an investor deposits $20,000 in a segregated fund. The 75% maturity and death benefit guarantees are $15,000 or $20,000 times 75%. If the market value increases to $50,000 in the 4th year of the contract, the guarantees will be $37,500 or $50,000 times 75%, if the contract is reset. Reset has 2 effects. It increases the value of guarantees, and it changes the contract's maturity date. Reset changes the maturity date of the contract. The new maturity date of the contract is 10 years from the reset date. For example, a contract that is reset in year 4 will mature 10 years from that reset date, a total of 14 years since the date the contract was taken out. Some insurers offer an automatic reset on segregated fund contracts in which the insurer automatically locks in growth of the account value. Others require the policy owner to make and implement the decision to reset. If reset is available, and it is up to the policy owner to make the reset decision, the owner is not required to reset the contract. The policy owner may not want to extend the maturity date of the contract. An additional fee may be charged annually to contracts in which reset is permitted. Also, an insurer may offer to reset on the maturity guarantee, separately from the death benefit guarantee. If so, the investor could choose to reset the maturity guarantee but not the death benefit guarantee, or vice versa. The insurer provides information regarding the number of resets allowed and the mechanisms to request or accept a reset in the fund's information folder. Example 1. An investor deposits $20,000 in a segregated fund. The 75% maturity and death benefit guarantees are $15,000 or $20,000 times 75%. If the market value increases to $50,000 in the fourth year of the contract, the guarantees will now amount to $37,500 or $50,000 times 75%, if the contract is reset. Example 2. Hassan deposits $5,000 to a segregated fund contract with a 75% maturity guarantee and 75% death benefit guarantee. Each guarantee is worth $3,750 or $5,000 times 75%. After 2 years, the market value of the contract is $7,000. Hassan's contract offers reset and he chooses to reset the contract. This increases the maturity and death benefit guarantees to $5,250 or $7,000 times 75%, and resets the maturity date of the contract. His contract now matures 10 years from the reset date, 12 years from the time of the initial deposit. Funding flexibility through ongoing deposits. The deposit or premium is the sum deposited to a segregated fund contract. Deposits can be made as a one-time lump sum or as a series of separate deposits. When a series of deposits are made, the maturity guarantee may be applied to each deposit date or the date of contract is signed. When the maturity guarantee applies to each deposit creates maturity date 10 years from when the deposit is made, and when the maturity guarantee applies to the date of the contract, deposits do not change the maturity date. Each deposit amount increases the maturity guarantee. Example: Sandra has a deposit date-based segregated fund with a 10-year term to maturity. She deposits $2,000 every year on January 1st for 3 years. At the end of 10 years, her maturity guarantee is $1,500 or 1 times $2,000 times 75%. At the end of 11 years, her maturity guarantee is another $1,500 and totals $3,000 or 2 times $2,000 times 75%. At the end of 12 years, her maturity guarantee is another $1,500 and totals $4,500 or 3 times $2,000 times 75%. Guaranteed income. A segregated fund contract may be structured to create a guaranteed income stream. Such a contract, or income benefit plan, is available in 2 forms. The Guaranteed Minimum Withdrawal Benefit, GMWB, plan pays income for a specified period of time. The Guaranteed Lifetime Withdrawal Benefit, GLWB, plan pays income for life. The segregated fund may be issued in one of these forms, or this feature may be added to an existing contract. Like all segregated funds, income benefit plans provide a maturity and death benefit guarantee. These plans are differentiated by the guaranteed income they provide. Not all insurers offer contracts with a guaranteed income feature. Also, there are many benefits, options, and restrictions that differ between these plans as offered by different insurers. Guaranteed Minimum Withdrawal Benefit, GMWB, and Guaranteed Lifetime Withdrawal Benefit, GLWB. Both the GMWB and GLWB plans are based on an initial deposit or deposits by an investor to a segregated fund contract. There are 2 phases to these plans: a savings phase, and a payout phase. The savings phase is a period when savings accumulate. During the savings phase, investors receive the potential for increase in fund market value. They also earn a credit or bonus for every year in which a withdrawal is not made. The credit is based on a percentage of the initial deposit. For instance, the credit may be 5%. The initial deposit plus the annual credits form a base on which a guaranteed minimum withdrawal is based, and any withdrawals during the savings phase reduce the value of the initial deposit, as well as the corresponding credits and final guaranteed minimum withdrawal amount. The payout phase starts when withdrawals begin. During the payout phase, the investor receives an annual income based on the guaranteed minimum withdrawal balance created during the savings phase. The amount received is based on the payout beginning at a specified age and lasting for either a specific period, such as 20 years or for life. A lifetime payout will be at a lower rate than if income is taken for a specified period because the contract value is stretched over a longer time. This is similar to the payment made from a life annuity compared to a term annuity. Lifetime income appeals to those who are concerned about outliving their financial resources or who seek an income stream during retirement. This is also similar to the reasons clients choose life annuities. As withdrawals are received, the value of the contract declines. However, the annual income guarantee is not affected. The same annual income is received even if the market value decreases. Extra withdrawals can be made that exceed the guaranteed income payment. They are penalized with fees. The payout value may be reset every 3 years. Reset creates a potential for increased income if the market value of the contract has increased, provided additional withdrawals have not been made, and the payout also increases if more premiums are contributed after the initial deposit. However, the payout never decreases below its guarantee. Professional management. Segregated funds employ professional investment managers to provide investment management and advice. These managers are compensated by fees, which are part of the management expense ratio, MER, charged against fund assets to investors. The investment managers are hired by the insurance company offering the segregated fund or funds. The insurer retains the right to appoint or change a manager. A management change is reported to investors. Even though the fund is managed by professional investment managers, the life agent is still responsible for working with the client to ensure the client's objectives are being met in the fund investment. Diversification. Segregated funds are highly diversified investments. This means their managers use a wide range of investments suitable to the type of fund. For example, an equity fund is highly diversified because it holds shares of many companies. Diversification lessens risk for the average investor since risk is spread over all the investments held in the fund. It is very unlikely all diversified assets in a segregated fund could lose value at the same time and to the same degree. Tax benefit of allocations. Segregated fund investing creates value for an investor in 2 ways. Market value of the investment may increase, and an investor may receive allocations from a fund. Mutual funds distribute income, segregated funds allocate income. When an investor makes a deposit to a segregated fund, the investor receives an assigned number of units. The number of units received is a result of how much is invested and their fair market value. It is essential for the investor to know the value of units when they are assigned if the investor wishes to follow performance and monitor an increase in the unit's value. An increase may indicate that a reset is in order. The number of units assigned to the investor does not change unless additional deposits or withdrawals are made. However, unit value changes. It increases and decreases in step with the value of assets held within the fund. For example, an investor invests $1,000 in ZYX fund, in which units have a market value of $10. That investor is assigned 100 units or $1,000 divided by $10. If the market value of the units increases to $12, the investment will be valued at $1,200 or $12 times 100. A unit value is determined for each fund offered by an insurer. The value is called the NAVPU or net asset value per unit. The term NAV, or net asset value, is also used. It is calculated as NAVPU equals total value of assets minus liabilities, divided by number of units outstanding. NAVPU is determined on each valuation day. For a fund investing in Canadian equities, a valuation day is when the Toronto Stock Exchange is open. Therefore, if a valuation shows an increase in NAVPU, the market value of the investment has increased. Allocations also benefit the segregated fund investor. Investment growth is generated in the form of interest, dividends, and capital gains. These earnings are not distributed to investors in the form of cash. If an investor wants cash from the fund, they must make a withdrawal by redeeming fund units. The interest, dividends, and capital gains earned by a fund are reinvested in that fund. They increase unit value and increase the investor's adjusted cost base, ACB, per unit. The ACB is a calculation that determines the tax cost of an investment to its investor. Increasing the ACB reduces tax when the units are sold. The investor receives the earnings on a flow-through basis. This means interest earned in the fund is reported for tax purposes to the investor as interest. Dividends earned are reported as dividends. Dividends from Canadian corporations are taxed at a lower rate than interest due to the dividend tax credit. Capital gains and losses are reported as capital gains and losses. Capital losses are used to reduce capital gains. They can be used in the year they are received or in the previous 3 years. They can also be carried forward indefinitely. Capital gains are taxed at a lower rate than other investments. Example. Henry invests $1,000 in WWW Segregated Fund Series B on September 1st. He is assigned 200 units on the basis that each unit is worth $5 or $1,000 divided by $5 equals 200. At the end of the year, a $100 allocation is made to Henry's policy and the unit value is fixed at $6 due to fund growth. Henry now has 200 units worth $1,200, and each unit is worth $6 or $1,200 divided by 200. The ACB of Henry's policy is now $1,100, the initial $1,000 investment plus the $100 allocation. The $100 allocation Henry received is reported on a tax slip issued by the insurer to Henry as $50 in interest and $50 in capital gain. The interest is taxed at Henry's marginal tax rate. The capital gain is also taxed at his marginal rate, but only 50% of the gain is taxable. $50 times 50% equals $25. If Henry's marginal tax rate is 36%, he pays $18 tax on the interest he receives. $50 times 36% equals $18. He pays $9 income tax on the capital gain. $25 times 36% equals $9. Switches between funds. An investor who wants to switch their account value from one segregated fund to another may do so. Why would an investor switch? To a fund that better matches the investor's risk tolerance. For better performance. For lower fees, such as MER. For a fund that better suits their investment objectives. The investor must be provided with the same information documents for the new fund as were received at the initial purchase. This includes both the information folder and fund facts for the new fund. When the switch is made, the value of the existing fund units is determined on the valuation date, which is either the day of the switch request or the following day. This is the sum that will be used to acquire units in the new fund. There is typically a minimum amount that can be transferred. Contract guarantees are not affected by fund switches. The number of switches the investor may make per year without incurring a switching fee may be limited. Individual funds state their switching policy, including any fees for switching in the information folder provided to the investor. An investor may incur a tax liability when a switch is made. An investor who switches funds where each fund charges the same load, for example, a front-end load, FEL, will not incur a fee for the switch. However, there may be a fee for switching between funds with dissimilar loads, for example, a deferred sales charge, DSC, to AFEL. Ability to withdraw, redemption. The investor enters into the segregated fund contract with the intention of seeing the contract mature in, at least, 10 years, that is, the term of the initial guarantee. However, if his financial circumstances change during the 10-year period, he may find he needs to make a withdrawal from the contract to receive cash in hand. A withdrawal is also known as redemption. A withdrawal can be made at any time. This provides investment flexibility. The withdrawal process begins when the investor informs the insurer of the amount the investor wishes to withdraw. The investor redeems the number of units that will provide the desired sum of money based on the market value of the units. The market value is determined at the valuation day following the request. The investor receives the money from the insurer within days of the valuation date. If the contract is issued with a DSC, the charge in force at the time of the withdrawal applies to the amount withdrawn. It reduces the amount the investor receives. For example, if the DSC applies for 6 years and is stated at 2% in contract year 4, then 2% is charged on the amount of the withdrawal made in year 4. The maturity guarantee and death benefit guarantee of the contract are reduced by the withdrawal. The insurer calculates the new guarantees according to the terms of the contract. A withdrawal may trigger a capital gain or loss. The contract owner receives a tax reporting slip from the insurer so that the potential gain may be included as income in the year it has been received. Exemption from probate fees. Probate is a process in which the will of a deceased is proven to be valid and the person appointed as executor of the will is accepted. It occurs in the provincial home court of the deceased and is finalized when letters probate or an equivalent document is issued. Probate fees are charged by the province against the value of a deceased's estate. Quebec does not charge probate fees. Probate fees must be paid by the estate of the deceased before any property can be inherited as specified in the will. These fees can significantly reduce estate value in a province, such as Ontario, that does not put an upper cap on probate fees. Probate fees are not charged to a trust when a surviving spouse inherits assets, and when the beneficiary of a segregated fund contract is not the estate. Instead, a named beneficiary receives the proceeds from the contract probate-free. A named beneficiary can include the spouse, parents, children, and grandchildren of the contract owner or annuitant. However, if the estate receives the proceeds, they become part of the total estate value and subject to probate fees. Probate also slows down distributions of assets. Because a segregated fund bypasses probate, its account value can be received by the beneficiary within days instead of the months it takes when an estate must go through probate. Investor protection. Assurance steps in to provide investor protection when an insurer becomes insolvent and cannot meet its financial obligation to pay guarantees. Assurance facilitates a quick transfer of policies from the insolvent insurer to another insurer that has the financial capacity to honor guarantees and benefits. Guarantee exceeds market value. Assurance protection is needed only when the guarantees of the segregated fund investment at maturity or death are higher than the market value of the fund. If the segregated fund contract guarantee is higher at the time of insolvency than the market value, the assurance protection applies. Assurance guarantees a segregated fund contract owner will retain up to $60,000 or 85% of guarantees, whichever is higher. In other words, it allows a segregated fund contract owner to retain 100% of his guaranteed investment if it is equal to or less than $60,000. For investments valued at more than $60,000, contract owners will retain 85% of guarantees. Example: Mark has deposited $100,000 to his segregated fund account, and the contract has a 75% maturity guarantee. Therefore, Mark is guaranteed to receive $75,000 on maturity. When his insurer is unable to pay the maturity guarantee due to insolvency, assurance coverage is applied. Mark is going to receive the greater of $60,000, or $75,000 times 85% or $63,750. Therefore, Mark receives $63,750 since it is greater than $60,000. Creditor protection. A person or entity, such as a business, who is owed money by another, is a creditor. A creditor may make a court claim for money owed if the borrower fails to make good on payment. Segregated funds provide the potential for protecting their contract owners from the claims of creditors. This protection is provided because segregated funds are issued as insurance contracts and a claim will not be successful if the spouse, parent, children, or grandchildren are named as beneficiary in the contract. The beneficiary is irrevocable, and the account is a registered account. A person must not try to avoid creditor claims by investing in a segregated fund. A segregated fund contract must be acquired for the purpose of investment, not for the purpose of avoiding creditors. Absence of medical underwriting. There is no medical underwriting for a segregated fund contract. This means that the health of the contract's policy owner or annuitant is not assessed and is not relevant to issuing the contract. If the policy owner or annuitant dies during the contract, the death benefit guarantee ensures the beneficiary receives the guaranteed minimum payment. Right of rescission. The right to cancel a contract is known as the right of rescission. An investor may rescind a segregated fund contract in writing within the specific time limitation set by the insurer providing the contract. 2 days is the usual length of time that is permitted. If the contract is rescinded, the investor receives the lesser of the amount of premium paid or value of fund units on that date if it is a valuation date. If it is not a valuation date, then the value on the next valuation date applies. 2.2. Types of segregated funds. The Canadian Investment Funds Standards Committee, CIFSC, classifies all fund investments into categories by asset class. Its 5 asset classes are cash, fixed income, equity, commodity, and other. This list of categories is helpful to start to understand the many types of funds since each class shares certain characteristics. Also, many funds have subcategories that narrow their investment objective. Why is it important to understand the classification of a fund? Classification is important so that funds can be correctly compared and aligned with investor risk tolerance. For example, if an investor has a low risk tolerance, then they will not be suited for a fund classed as an equity fund. A better choice will be a lower risk fund, such as a bond fund invested in government bonds. Each fund may be highly diversified. Top holdings are described in the fund facts document or information folder. Other holdings for each fund may be too numerous to list. Note that the actual names of funds often bear little relationship to the asset classes and categories defined by CIFSC. Money market funds. Money market funds are the lowest risk funds and, correspondingly, have a low rate of return. Money market funds must invest at least 95% of their total net assets in cash or cash equivalents, such as Government of Canada short-term bonds or Treasury bills. Bond funds. Bond funds are a fixed income type of fund. These funds must invest a specified percentage of their holdings in fixed income securities such as bonds and Treasury bills. Fixed income securities pay a specific return periodically and they return principal invested at maturity. Fixed income funds may be categorized as short-term or long-term. This term describes when the holdings in the fund mature. For example, a fund is described as short-term when it matures in less than 3.5 years. A long-term fund matures in 9.0 years or longer. Fixed income funds are described in the currency of the security held in the fund. For example, Canadian dollar-denominated securities in a fund refer to a Canadian fixed income fund. Fixed income funds are generally low risk and have a low rate of return. Some funds may invest in securities with a lower credit rating to achieve a better return. These funds may be called high yield. High-yield bonds are also known as junk bonds and such funds carry much higher risk than traditional bond funds. Equity funds. Equity funds are also known as growth funds. They invest in stocks of publicly traded companies and income trusts to generate dividend income and increase in value. Stocks held in an equity fund may be diversified or concentrated in a particular sector, such as financial services. Higher levels of risk are experienced when an equity fund is concentrated in one sector. Such a concentration means the fund is insusceptible to industry risk in that sector. Fund growth is achieved by reinvesting dividends paid on fund holdings and through the increase of the share prices of the stocks held in the fund. There is a higher degree of risk with an equity fund compared to bond funds or money market funds. Equity funds by market capitalization. The larger the market capitalization of a stock, generally the lower the investing risk. Funds are available as small cap, mid cap, or large cap, each invests in its corresponding type of company. For example, a small cap equity fund in Canada invests in Canadian companies that are considered small cap. Market capitalization varies significantly between countries. For instance, in the US a large cap company is valued at $10 billion or more, whereas it is valued at $5 billion or more in Canada. Income funds. Income funds are based on the stability of bonds. They pay regular interest income and have the possibility of capital appreciation. Income funds are not restricted to bonds, and some may also hold high-quality stocks. When stocks are included in the income fund portfolio, the unit owner may receive both dividends and capital gains from his investment. Both government and corporate bonds may be held in income funds. Income funds are one of the lower risk fund types. Returns to investors are also correspondingly low. Balanced funds. Balanced funds invest in both stocks, for the growth potential they represent, and bonds, for the safety the category represents. Balanced funds are also known as balanced growth or balanced income funds. A balanced growth fund emphasizes stocks. A balanced income fund emphasizes bonds. The risk associated with these funds depends on how the balance is weighted. Stocks are higher risk, bonds are lower. When there is an even split, risk is averaged out. Balanced funds suit an investor who wants some exposure to stocks but is not prepared for the volatility of stocks alone. Dividend funds. A dividend fund invests in companies that have a history of paying steady and rising dividends. A dividend is a distribution of company profits by the board of directors to company shareholders. Dividends are not guaranteed, but the obligation to meet dividend payments is taken very seriously by a company and its investors. Dividends received from Canadian corporations are taxed at a lower rate than interest income as a result of the dividend tax credit. This increases investor appeal. A dividend fund may also invest in bonds. Dividend funds are considered low to medium risk. Mortgage funds. The securities in a mortgage fund are primarily residential, commercial, and industrial. Mortgage funds are categorized as another type of fund. Low-risk mortgage funds are a type of fixed income fund. Default risk is associated with a mortgage fund. It is experienced when mortgage holders default on, that is, fail to make, their mortgage payments. Real estate funds. Real estate funds must invest at least 90% of their assets in retail, commercial, industrial and residential properties. They earn income from mortgages and have the potential for capital gains as property values increase. Real estate funds own property, mortgage funds do not. Some funds invest in real estate investment trusts, REITs, companies that, in turn, invest in real estate. The risk of each fund will be a result of the types of properties in which the fund invests and their location. Real estate funds are particularly suitable for long-term investments because property values need to be given enough time to rise in value. Real estate is an illiquid investment. It may not be possible to sell or sell at the desired price to redeem invested money. Index funds. An index fund mirrors an index, such as the S&P or TSX Composite Index, and invests in the same stocks that are listed on the index. Therefore, if the index rises, the index fund will also rise. Its results will be slightly less than the actual index because of the management fees that are charged to the fund. This style of investing is known as passive investing as there are virtually no decisions required of the investment manager. Index funds may be based on equity markets or bond markets. The risk of the fund is a result of the underlying market the fund tracks. Fund of funds. A fund of funds is a fund that invests in other funds. The purpose of this approach is to benefit from managerial expertise in other funds and to diversify. The fund manager decides which funds suit the portfolio based on the fund objective and the manager rebalances holdings as needed to maintain the objective focus. The risk of the fund is entirely a result of the underlying funds in the portfolio and its investment objective. Specialty funds. Some funds are created to appeal to specific investor wants and needs. They are called specialty funds. Specialty fund categories, such as ethical funds, fill important investment objectives for their investors. Ethical funds provide an alternative for investors who for religious, political, or moral reasons find the holdings of standard funds unacceptable for investment. Investors who seek ethical funds are less concerned about the risk of the fund since their primary goal is to support a cause or belief. Other specialty funds include emerging market funds or funds that seek companies that are struggling financially. The risk of specialty funds lies with the fund's objective and investment strategy used by the fund manager. Each one should be carefully studied to determine if its risk is suitable for the investor. Industry-specific funds. Industry-specific funds represent the belief an investment manager has in the financial prospects for an existing or new industry, service, or product. The risk of industry-specific funds depends on the industry that forms the basis of the fund, its volatility, and its prospects. Geographically specific funds. Certain funds focus on investments within a country, for example, Canada. Outside the boundaries of a country, for example, North America. Of a selection of countries, for example, international. Of a region, for example, Asia. Of part of a region, for example, Asia except Japan, and of the entire globe. Countries change in their appeal to investors over time. Some become very attractive investment opportunities while others lose their appeal. Political volatility is a risk associated with investing outside Canada and similarly developed nations. Currency risk is another risk of investing abroad. Investors who seek foreign opportunities should be well aware of the political situation and economic stability of the country or region in which they plan to invest. They should also monitor changes that might affect the investment, for example, an election. New introductions. Funds evolve over time for a variety of reasons. They may want to offer new investment opportunities or provide new features. Funds that have lost their appeal are closed and may be amalgamated with other funds. 2.3. Segregated fund limitations. The limitations of segregated funds should be as understood as their benefits. The limitations of segregated funds will be discussed in the following pages and include risk to capital, sales charges, management expense, penalties, and age restrictions for acquisition. Risk to capital. The principal risk of segregated funds is that the investor could lose up to 25% of their capital when the contract provides 75% maturity and death benefit guarantees. Another risk is the fixed term to maturity period of the standard contract. This makes segregated fund investing a long-term investment. If the investor needs to make a withdrawal before the contract matures, they do not receive the benefit of the maturity guarantee and receive market value for the withdrawal minus any outstanding sales charges, such as the deferred sales charge, DSC. Risks associated with segregated fund investing also depend on the types of investments held in the fund itself. For example, bonds are lower risk than equities. Therefore, a bond fund is lower risk than an equity fund. Sales charge. The charge paid by investors to compensate the agent is called a sales charge or a load. Sales agents may be compensated for their time, skill, and effort through a direct charge paid by investors and indirectly through a trailing commission. The charge paid by investors is known as a sales charge or a load. Front-end sales charge. A front-end sales charge is a fee charged at the beginning of the contract, known as its front end. The front-end sales charge is also called a front-end load, FEL. The fee is charged to the client as a percentage of the amount the investor deposits to the segregated fund contract. It reduces the amount of investment dollars that go to work for the client. The FEL also reduces the maturity guarantee and death benefit guarantee because it reduces the sum applied to the contract. The amount charged is usually negotiable between agent and client. The investor who pays a FEL pays no further sales fee if they redeem units during the term of the contract. For example, Jose has $10,000 to deposit to a segregated fund contract with a FEL of 5%, $500. The contract value therefore begins at $9,500, $10,000-$500. This is the amount on which the guarantees are based. Deferred sales charge, DSC. The DSC applies over a set period of time to a full or partial withdrawal from a segregated fund. The charge is a percentage applied against the amount withdrawn. It declines over a number of years until it is eliminated. The DSC encourages investors to keep their investment and not to surrender the contract while the sales charge is in place. It also informs them of what to expect as a sales charge if they proceed with a withdrawal or surrender. Example of DSC. Length of time after premium is paid. Charge. Less than 1 year 5.0%. 1 to less than 2 years 4.5%. 2 to less than 3 years 4.0%. 3 to less than 4 years 3.5%. 4 to less than 5 years 3.0%. 5 to less than 6 years 2.5%. 6 years or more 0.0%. Example. Josephine deposits $10,000 to her segregated fund contract with a DSC. 2 years later she needs some of the money. She withdraws $5,000. The sales charge applicable is 4%. Therefore, she pays $200, $5,000 times 4%, as the DSC. No sales charge. Segregated funds that do not have a sales charge are called no-load funds. They may compensate for the absence of a sales charge by charging a higher management expense fee. Management expense. The management expense is the combination of management fees for a fund, its operating expenses and the cost of paying for maturity and death benefit guarantees. These expenses are added together and expressed as an annual percentage of the total value of the fund known as the management expense ratio, MER. The management fee compensates the fund management company for the cost of a portfolio manager and fund oversight. The MER of segregated funds is typically higher than the MER for an equivalent mutual fund. A segregated fund must maintain a reserve to uphold segregated fund maturity and death benefit guarantees. This is sometimes called the insurance charge. MERs are charged whether the market value of the fund increases or loses ground. They reduce investor returns. For example, if the value of units rises by 5% in a year and the MER is a 3% charge, the investment has actually only gained 2% or 5% minus 3%. If the unit value falls by 5% in a year and the MER is a 3% charge, the value of the investment will actually have decreased by 8%, minus 5% minus 3% equals minus 8%. Higher MERs are associated with funds requiring more active management and decision-making, such as those that incur trading fees by buying and selling stocks. Low MERs are charged by funds such as index funds that require less active management and decision-making since the manager simply follows the index itself. The MER of a fund can be changed at any time by the insurer. Investors must be notified of the change. Trailing commission. A trailing commission is a sales compensation fee incorporated in the MER and is paid as long as the investor holds the fund. The trailing commission is calculated as a percentage of the market value of the fund. Penalties. Withdrawals and surrender of the contract may be penalized by the insurer. Such penalties are applied against the value of the contract and reduce the sum received by the investor. The policy of each insurer states their charges for withdrawals and surrender. Age restrictions. There are age restrictions for both the last age to establish a segregated fund contract and the last age at which a deposit can be made. RRSP. The oldest age at which a contract can be begun as an RRSP is 71. Deposits can be made until December 31st of the year in which the contract owner turns 71, then the RRSP is converted to a RIF. RIF restricts the last age for authorized transfer, for instance from the rollover of a spouse's RIF, at 90. Non-registered accounts and tax-free savings accounts, TFSAs, restrict the age limit for deposits to 90. There are provincial variations among other types of registered accounts and age limits associated with each. 2.4. Segregated fund taxation. The taxation of segregated funds is very complex. The following details are an overview. An investor should always seek tax expertise from a tax professional regarding taxation of a segregated fund account. Taxation of a segregated fund is based on two fundamentals. Whether the account is non-registered or registered, for example, an RRSP, and the form of investment income earned in the fund. Tax on deposits. Deposits or premiums paid into a non-registered account or a TFSA are not tax deductible. Deposits or premiums are tax deductible when paid into a registered account, except when the account is a registered education savings plan, RESP, or a registered disability savings plan, RDSP. Tax on allocations. Investment income can be earned in both non-registered and registered accounts as interest, dividends, capital gains or losses, and foreign income. In a non-registered account, these forms of investment income are passed from the fund through to the investor. This is the allocation, as was explained earlier in this chapter. The investor receives a tax slip from the insurer and reports the income on his annual tax return. The investor also reports the capital gain or loss and the switch of units and certain other events that occur within the fund. In a registered account, these forms of investment income are allocated to the investor, but they are not reported for annual tax purposes. Tax on withdrawals. When units of a non-registered account are redeemed for a withdrawal or on contract maturity, a capital gain or loss will be incurred. This must be reported on the investor's annual tax return. The amount of gain or loss is based on the adjusted cost base, ACB, of the units and their market value when they are redeemed. When a withdrawal is made from a registered account, it must be declared for tax purposes and the entire amount withdrawn is taxed at the same rate as interest income, except if the amount is a TFSA in which no tax is declared or paid. The insurer withholds an amount specified by the Canada Revenue Agency, CRA, for RRSP withdrawals. On maturity of an RRSP, at the end of the year in which the account owner turns 71, the account value can be rolled into an RIF account so that tax is only paid on withdrawals. RIF accounts require a minimum annual withdrawal. The first payment must be received in the year after the account was set up. There is no withholding tax on this minimum. Withdrawals above the minimum have the withholding tax applied. TFSA accounts do not require payment of tax when a withdrawal is made. Tax on maturity guarantee and death benefit guarantee. The taxation of an amount paid as the maturity guarantee or death benefit guarantee top-up for a non-registered account is not currently defined under the Income Tax Act or by the CRA. The insurer must report to the investor the amount paid as the top-up. The investor will then determine with his tax advisor and the CRA how that amount is taxed. Top-ups for guarantees required for TFSAs are not taxable. Chapter 3, Annuities. 3.0. Annuities. Annuities are an investment product that takes the form of a contract which specifies terms of payment. Life insurance companies issue all forms of annuities. Banks and other financial institutions may only issue one form of annuity, known as a term annuity or term certain annuity. Annuities are usually structured to pay a regular income to the person named as the annuitant in the contract, and this is typically their most important feature. The factors that influence how much the annuity pays to the annuitant are the quoted annuity rate, and guarantees on the annuity payment, if any. Annuities that pay an income are called payout annuities. They are differentiated by whether the payout begins immediately, an immediate annuity, or at a future date, a deferred annuity. Payout annuities are purchased by the payment of a premium or deposit to the annuity contract by the contract's owner. The contract's owner chooses a schedule for payments, also called the annuity benefit, and the duration for payments, either for life, a life annuity, or a period of time, a term annuity. Once annuity payments begin, they generally cannot be stopped before the end of the payment period. Most payout annuities are issued with a set, or level, payment unless the annuity is either an indexed annuity or a variable annuity. In addition to payout annuities, Canadians can also buy accumulation annuities. An accumulation annuity does not pay income, but provides a way to accumulate funds in the form of savings with a maturity date. At maturity, the savings in the annuity may be converted into a payout annuity or surrendered, paid to the owner, without penalty. Annuities provide investment security because they offer a high degree of dependability for the investor. In addition to the security they provide, annuities are easily understood, provide income security, creditor protection, and estate planning benefits and protection for the annuitant in the form of insurance against the issuer's insolvency or bankruptcy through assurance. 3.1. Advantages of annuities. The following advantages of annuities are explained in more detail in this section. Easily understood investment concept. Income security that can be adapted to the client's needs and situation. Creditor protection. Estate planning benefits. Annuitant protection, assurance coverage. Easy to understand concept. Payout annuities are the most common form of annuity and are what most people think of when they think of an annuity. In simple terms, the idea underlying all payout annuities is the following. Note, there are many nuances available to customize payout annuities to individual needs. An individual has a lump sum of capital to invest. He wants to invest it at a set interest rate and receive some of his capital plus interest every year. Insurance companies offer an investment product called a payout annuity. The investor deposits his capital to the annuity and becomes an annuity contract owner. The investor decides who is going to receive the money from the contract. This person is called the annuitant. The insurer pays the annuitant a portion of the capital and some interest earned in every regular payment. The payment schedule is selected by the contract owner. Payments to the annuitant begin according to whether the annuity is immediate or deferred. Payments continue for life for the term of the contract. Life annuity ends on death of the annuitant. Term annuity ends on its maturity date. Income security. All annuitants have the security of knowing when to expect their annuity payment based on the schedule selected in the annuity contract. Annuities with a level, or set, payment provide income security because the annuitant also knows in advance how much each payment will be. The payments are guaranteed by the issuer. This knowledge allows annuitants to plan their finances and spending. This is one reason this form of annuity is a good choice for retirement income. Level payments are also a way the owner can control the amount of income to be paid to an annuitant when the annuitant is unable to manage his or her personal finances on their own. For instance, a parent could establish an annuity for a mentally challenged child with the assurance that the child would receive a regular payment of a known sum. The income security provided by an annuity may last for the lifetime of the annuitant, the lifetime of a spouse, or temporarily over a defined period of time. Lifetime income. When payments are paid for the lifetime of the annuity has been issued as a single life or straight life annuity. Annuities can also take the form of joint life, in which one annuity names two annuitants, who are usually spouses. Payments continue for the life of the surviving annuitant after the first annuitant dies. A joint life annuity can function like a pension to provide retirement income. When payments are provided with a lifetime guarantee, the annuitant, and their spouse, if a joint life annuity is selected, do not have to worry about outliving their money, even if they live for a very long time. Spousal income. An annuity can be used to provide income for a spouse using a single life annuity in which a spouse is named as annuitant. Joint annuity in which both spouses may receive annuity income, and after the death of the first spouse, the surviving spouse continues to receive the annuity payment. Temporary income. A term annuity provides an income to an annuitant for the term or period of time stated in the contract. The payment period may be as short as a few years, or last for decades. A term annuity can be used to fill the gap between two dates, such as between the time when an employee takes an early retirement and the time a workplace pension begins. In this case, the term annuity would provide income after early retirement, and before the pension begins. Creditor protection. People who are self-employed, business owners, and professionals may find the creditor protection available through an annuity of particular benefit because they are more likely to find themselves in situations in which creditors make a claim against their assets. When an annuity names specific beneficiaries, rather than the owner's estate, the amount deposited to the annuity contract is protected against financial claims made by creditors of the contract owner. The intention of the law, providing that annuity deposits cannot be accessed by creditors, is to protect the dependents of an insolvent contract owner from creditor claims. The value of the contract cannot be claimed by creditors when a spouse, child, grandchild, or parent is named as the beneficiary or beneficiaries of the annuity contract, or when an irrevocable beneficiary is named. Some annuities offer unseizable benefits, such as annuities funded by a transfer of a lock-in pension, coming from a locked-in retirement account, LIRA. However, if a contract owner surrenders their term annuity and receives its commuted value, as a lump sum, that lump sum does not benefit from creditor protection. To benefit from creditor protection, the contract must have been purchased significantly in advance of the owner's insolvency. This requirement ensures the owner has not purchased the annuity as an attempt to escape financial obligations to creditors. Estate planning benefits. Annuities offer a valuable estate planning feature through the ability to name a beneficiary to a contract. When annuity payments are made to a beneficiary, those payments bypass the estate and are thus not subject to probate fees. The beneficiary also receives funds faster than if they were waiting for the estate to be settled. Insured life annuity. An insured annuity is the name given to a strategy that combines two separate products. It is a combination of permanent life insurance and life annuity. Its purpose is to protect estate capital. The insured annuity process is: a proposed policy owner identifies the sum of money needed on death to settle their estate. They acquire permanent life insurance, such as Term 100, T100, or whole life insurance, with a death benefit that is equal to the sum required to settle their estate. If the proposed policy owner does not qualify for life insurance, the insured annuity cannot be implemented, and the process must stop at this point. After the insurance policy is issued, the life insured buys a life annuity with a deposit that is sufficient to ensure that the annuity payments will, at a minimum, cover the life insurance premiums as they come due. Upon the death of the life insured, who is also the annuitant, the life annuity contract and payments end, and the life insurance death benefit is paid to beneficiaries and/or the estate. Beneficiaries do not receive the capital of the estate through the will, but because the insured annuity matches the needs of the estate to the life insurance death benefit, they will receive an equivalent amount of capital from the life insurance policy death benefit, tax-free. Example: Stephen, aged 60, wants to leave his two nieces a legacy of $250,000 each on his death. If he puts aside the $500,000 now, he no longer can spend that money. Instead, Stephen purchases a Term 100 life insurance policy with a $500,000 death benefit. He names his nieces as beneficiaries of the policy. Premiums for the policy are $1,000 per month. Stephen then acquires a single life annuity using $200,000 of his savings. He receives about $1,000 per month in an annuity payment. He uses the money to pay his life insurance premium. He has effectively bought an inheritance of $500,000 for the sum of $200,000. He still has access to $300,000 of his savings to use for other purposes, such as retirement. Annuitant protection assures coverage. If an insurer that has issued annuities is no longer able to meet its payment commitments, the policies are then transferred to another insurer that is able to make payments. The transfer process is facilitated by a surus, who also guarantees future payments up to specified limits. An annuitant receives a surus protection on a payout annuity on the payment in full when it is up to $2,000 per month. For example, if a promised benefit is a level $1,000 per month, the annuitant will continue to receive $1,000 per month after the policy has been transferred to a new insurer. When a benefit for a payout annuity is more than $2,000 per month, the annuitant receives a surus protection for the greater of $2,000 per month or 85% of the promised benefit. For example, if a promised benefit is $5,000 per month, the annuitant would continue to receive $4,250 or $5,000 times 85%. For accumulation annuities, a surus protects up to 100% of the contract value, to a maximum of $100,000. Therefore, if an accumulation annuity value is less than $100,000, the policy owner receives all of their deposit value. If the annuity value is greater than $100,000, they receive $100,000. 3.2. Types of annuities. Many factors must be addressed while selecting the type of annuity suited to the client's needs and expectations and while preparing a contract. These factors are addressed in the sections that follow. Purpose of the annuity. As mentioned earlier in this module, the two core forms of annuities are the payout annuity and the accumulation annuity. The purpose of each type of annuity is very different, so it is important for agents to understand which type best suits which circumstances. Payout annuity. The purpose of a payout annuity is, as its name suggests, paying out income. The income stream received from a payout annuity is a blend of interest and principal created from the deposit of capital to the contract. The payment amount is based on the annuity rate applied at the time the contract is issued. All forms of annuities, immediate, deferred, term, life, and joint life, are payout annuities. The exception is accumulation annuities. Accumulation annuity. An accumulation annuity is a form of savings with a built-in maturity date. Accumulation annuities did not provide an income stream. Instead, their purpose is investment growth. Accumulation annuities are similar to a guaranteed investment certificate, GIC, but come with the features of a life insurance contract, such as the ability to name a beneficiary and creditor protection. The accumulation annuity credits interest of deposits on a daily, monthly, or compound basis. Daily interest is not a guaranteed sum. In certain cases, interest may be guaranteed over a number of years, such as 1 year, 5 years or 10 years, because the annuity deposit is used to buy a fixed-term investment at a guaranteed interest rate. Interest applied to deposits increase the accumulated value of the annuity. Once the annuity has matured, it may be surrendered for its accumulated value or it may be converted into a payout annuity, which will pay a fixed amount based on the accumulated value and the annuity rate in force at the time of maturity. Lives covered. Once the fundamental purpose for the annuity contract is identified, the number of lives to be covered by the contract can be established. Single life contract. A contract may be issued to a person, naming them as an annuitant, or naming another as the annuitant. The annuitant receives the income from the annuity contract for a specific period or life, depending on whether the annuity is a term certain annuity or lifetime payout annuity. Joint life contract. A joint life contract, also known as a joint and last survivor annuity, pays an income over the lifespan of two people, usually spouses. The two individuals named in the annuity are known as co-annuitants. Payments may be issued to both annuitants or one annuitant. When the first annuitant dies, payments continue to the co-annuitant, typically the surviving spouse. The contract may be structured to pay the co-annuitant 100% of what had been received by the deceased annuitant, or a reduced percentage of the full payment. The reduced amount paid is usually 50%, 60% or 75% of the full payment. Duration of the annuity. An annuity is issued for a term, a period of time, a lifetime, or the lifetimes of two people. Term. A term annuity is issued to pay income to a specified age, such as to age 71, or for a specific length of time, such as 10 years. All other factors being equal, the longer the term, the less received in each annuity payment. This is because the income from the deposits must be stretched over a longer period of time. For example, Donald, aged 65, deposits $100,000 to a 5-year term annuity. He receives approximately $1,700 per month in his annuity payment. If the annuity were a 10-year term, he would receive about $955 per month. When a term annuity ends, all payments cease because the annuitant has received the entire principal deposited to the contract, along with the interest earned on that principal. If death of the annuitant occurs during the term of the annuity, the balance of annuity payments is paid to a beneficiary as either monthly payments for the period remaining in the term, a lump sum payment that represents the present value of all future payments. This is also known as the commuted value of the annuity, or the amount that remains of the original deposit. For example, if the contract was funded with $100,000 and $75,000 had been paid out, the beneficiary would receive $25,000, $100,000 minus $75,000. A term annuity to age 90, T90, is an annuity option available to those whose registered retirement savings plan, RRSP, is maturing, and the RRSP account must be closed. Using some or all of the value in the RRSP to buy a term annuity continues tax deferral on the money. Additionally, a term annuity to age 18, T18, is available for financially dependent children who are younger than 18 to provide income when a parent or grandparent dies and has named them as beneficiaries of the deceased's RRSP or RIF. The lump sum in the registered account is transferred to an annuity for the child tax-free. The child receives payments from the annuity until, at the latest, the day before he or she turns 19. Tax on the payments is paid by the child at his or her marginal tax rate. A life or 2 lives. An annuity may be structured to pay an income over the lifetime of 1 person or 2. When 2 lives are covered in an annuity, the annuity is called a joint and last survivor annuity. Example: Ted and Joan buy a joint and last survivor life annuity with $100,000. Ted and Joan are the policy co-annuitants, and the contract is structured to pay Joan 50% of the full benefit upon Ted's death. Ted receives $450 per month as his annuity payment. Joan does not receive a payment. When Ted dies 20 years after receiving his first payment, payments are then issued to Joan, and she receives $225 per month. When Joan dies after receiving payments for 6 months, the annuity ends. No further payments are made. A shortened life. An impaired annuity is a form of life annuity. An impaired annuity is issued when the annuitant has a shortened life expectancy due to poor health because of a serious disease or deteriorating condition. An impaired annuity can be bought for a single life annuitant or joint life annuitants when both spouses suffer from medical conditions that lead to shortened life expectancy. Impaired life annuities are also called enhanced, age-rated, or accelerated annuities. The amount of payment received by the annuitant is based on underwriting of their medical condition. The annuitant must provide a medical certificate proving substandard health. Once an impairment is proven, the annuitant either pays a lower premium, or receives a higher payment than someone who does not have a health condition because payments are expected to be issued over a shorter period corresponding to the shortened lifespan. 3.3. Funding an annuity. A policy owner may fund, or pay for, an annuity in a lump sum, in a transfer of a lump sum, or payments may be made over a period as deposits to the annuity contract. An immediate annuity must be funded with a lump sum or transfer of funds so that capital is immediately on deposit with the insurer to begin payments within the first year of the contract. A deferred annuity can be funded with a lump sum or a series of deposits. Lump sum deposit. A lump sum deposit is made when funds are transferred from a registered or non-registered account to the annuity. The deposit occurs just once from non-registered investor savings and investments or by transfer from a registered account. Transfer from a registered account. Transferring funds from a registered account, such as an RRSP or RIF, continues the tax deferral on the amount that is transferred to a registered annuity contract. Therefore, there is no tax consequence for a transfer. When registered savings are the source of funding of the annuity, the policy owner and annuitant must be the same person. They can choose a life of T90 annuity. Locked-in pension savings accumulated in an employer-provided or group pension plan can be transferred only to a life annuity, including funds in a LIRA, LIF, or a PRIF. When a spouse transfers locked-in savings from a registered pension plan, LIRA, or LIF to fund an annuity, they must usually acquire a joint and last survivor life annuity. This ensures that if the pensioner dies before his spouse, The surviving spouse will continue to receive an income. That spouse can waive the right to the annuity in writing. Regular deposits. Deposits, or premiums, made on a regular ongoing basis can also fund an annuity. Annuity payments cannot begin for any type of annuity until after the last deposit has been made and the annuity is fully funded. 3.4. Annuity income. The contract owner of a payout annuity must choose one of the following on the application. Whether the annuity income payments begin immediately or at a selected future date, that is, payments are deferred, and whether the payments will be a level amount or variable amount. Immediate income. Payments can begin immediately when a lump sum funds the annuity. The lump sum deposit followed by immediate payments is an immediate annuity. The annuitant receives their first payment at the next payment date after the contract is finalized based on the payment schedule that was selected. This may be the next month, 3 months, half year, or year. Deferred income. A policy owner who selects their payments to begin at a future date has a deferred annuity. There are 2 phases to the deferred annuity. During the accumulation phase, the annuitant either deposits a lump sum to the contract or pays regular premiums. Deposits held by the insurer earn investment income. The income, or payout, phase begins at the end of the deferral period, for instance, 10 years after the first deposit. A maximum length of time permitted for the deferral will be stated in the contract. Level income. A level payment is a payment that is the same for the duration of the annuity. The annuitant knows exactly the sum to expect in each payment. Indexed income. In contrast to annuities with level payments, indexed income provides payments that increase over the payment period to keep in step with inflation, thus maintaining the purchasing power of the annuity payments. Indexing an annuity increases payments annually by a percentage selected by the policy owner. Therefore, income increases year over year to keep pace with rising costs. The maximum amount of yearly increase is capped, for instance at 4%. Variable income. A variable income annuity is an immediate life annuity which also allows the annuitant to earn investment returns that are linked to market performance. A market-linked return is a return linked to performance of a market index, such as the Toronto Stock Exchange, TSX. The annuitant who has a variable income annuity is paid on the basis of annuity units. The annuitant receives a set number of units at the time the deposit is made. The contract owner chooses the investment mix on which unit is based, and also selects a rate of return that must be attained before increase. If the value of the units increases above the chosen rate of return, the annuitant's income increases as the payments increase in accordance with the rate of return. If the value of the units declines, the annuitant's income will fall as the payments decrease. 3.5. Factors affecting annuity payments. Many factors affect the amount received as the annuity payment. Annuity quotes and rates are specific for each person. Buyers will often comparison shop between issuers to get the best rate. Annuity rate. The annuity rate is a dollar figure quoted to future policy owners that they will receive as their annuity payment. It is based on the current interest rate and other factors that are specific to the annuitant and to how the annuity contract is structured. In effect, the annuity rate represents the return on the sum invested in the annuity. For example, Bernadette purchases an annuity contract with an annuity rate of $6,000 per $100,000. If she deposits $300,000 in the annuity, she will receive payments of $18,000 or $300,000 divided by $100,000 times $6,000 annually. The annuity rate also takes into consideration costs that are applied against the contract, such as commission and insurer expenses. Rates differ between issuers since they do not all use the same interest rate or calculation of cost factors. Interest rate. The interest rate in effect at the time the contract is issued is a major factor in determining the payment to the annuitant. The interest rate assigned to the annuity never changes over its duration, that is, if interest rates change during the term of the annuity payment does not change in response. It is based largely on the prevailing interest rate offered in other forms of interest-bearing investments at the time the contract is issued. Age of annuitant. The age of the annuitant when payments begin is a significant contributor to the amount received as income from life annuities. The older the annuitant, the larger each payment will be since on average, fewer years remain for payments to be made. Gender of annuitant. Women receive a lower life annuity payment because, on average, they live longer than men. Therefore, to receive the same income as a male annuitant at the same age, a larger deposit is required. Deposit amount. Insurers want to attract large accounts. To do so, they may offer a higher annuity rate to those who have more to invest. Payment schedule. Slightly more is received when the length of time between payments is longer rather than shorter. This is because the insurer has the unpaid sums at its disposal to invest. Therefore, a single annuity payment received at the end of each year, for example, will be slightly more than 12 monthly payments. Length of payment period. When the policy owner buys the annuity contract, they commit to deposit a set amount of principal or capital to the insurer. The insurer then pays out that principal plus interest over the period represented by the type of annuity chosen, term or life. The longer the payment period is expected to be, the lower the amount of each payment. Example. Rosario is 60 years old and healthy. He invests $100,000 in an annuity contract. Scenario 1. He purchases a 10-year term annuity. Assuming it is paid to maturity, it will yield 120 monthly payments, 10 years times 12 months. Based only on 10 years of payments, Rosario could receive a monthly payment of $833 or $100,000 divided by 120. Scenario 2. He purchases an immediate life annuity. The insurer's mortality tables indicate his expected lifespan is 24 years. The annuity is thus expected to yield 288 monthly payments, 24 years times 12 months. Based only on 24 years of payments, Rosario could receive a monthly payment of $347 or $100,000 divided by 288. Guarantees. There are 3 reasons for a guarantee in an annuity contract. To guarantee that payments equivalent to what would be paid over a period of time are issued from the contract, which is known as a guarantee period, or a guarantee payment of the initial capital, which is known as a capital protection guarantee. To guarantee an income for a spouse. To guarantee that premiums are repaid. Guarantees increase the cost of the annuity for the policy owner, decreasing the amount the annuitant receives. Guarantee period and guaranteed capital. A term annuity is guaranteed for its entire term. If the contract owner dies during the term, a beneficiary receives the remaining value of the annuity. The 3 options available for a beneficiary are discussed in Section 3.2. A life annuity can be issued with or without a guarantee period. The guarantee period is stated as a number of years, such as 5, 10, or 20 years. If the annuitant dies before the end of the guarantee period, the beneficiary receives a payment from the contract. The amount the beneficiary receives represents the difference between the number of payments provided for the guaranteed period and the number of payments the annuitant received. For example, Annette purchases a life annuity that is paid monthly with a 10-year guarantee period. She names her twin sister, Ava, as the beneficiary of the contract. The guarantee ensures that the annuity will issue a minimum of 120 payments, 12 monthly payments per year times 10 years. If Annette dies after receiving 100 payments, her sister Ava will receive the equivalent of 20 payments, 120 minus 100. The amount the beneficiary receives may be paid as a lump sum, corresponding to the current value of future guaranteed payments, or installment payments for the remainder of the guaranteed period. A life annuity is sometimes issued with a capital protection guarantee. When this option is selected, the beneficiary receives an amount corresponding to the difference between payments received before death and the initial capital. The annuity is called a cash refund annuity if the beneficiary receives a lump sum. If the amount is paid in installments, the annuity is called an installment refund annuity. A life annuity without a guarantee has elements of risk. The annuitant of a single life contract could die after receiving their first monthly payment, and with no guaranteed, there would be no additional payments made to a beneficiary. The balance of the sum invested with the insurer would then belong to the insurer. However, a life annuity without a guarantee also pays at a higher rate than when guarantees are added. The contract owner or annuitants must weigh the higher return against the higher risk to decide which form of annuity is most suitable. Guaranteed survivor income. When a joint and last survivor annuity is chosen, survivor income is guaranteed for 2 lives. A guarantee period can also be added to the contract to provide the assurance that a certain amount will be paid out as a result of the amount invested. Example. Tony and Jane buy a $100,000 joint and last survivor life annuity with a 10-year guarantee. Tony and Jane are co-annuitants. Jane is set to receive the full amount of the benefit upon Tony's death. Tony and Jane's son, Roger, is the beneficiary. Tony receives $300 per month as his annuity payment. Jane does not receive a payment. When Tony dies 2 years after receiving his first payment, payments are then issued to Jane. Jane receives $300 per month until she dies 3 years later. Payments were made to Tony and Jane for a total of 5 years. Roger receives a sum equivalent to 5 years' payments because the contract has a 10-year guarantee, that is, $18,000. $300 times 12 months times 5 years. He chooses to receive the amount as a lump sum. Because annuity payments to a surviving annuitant extend the period of payment, joint annuities generate lower payments than a single life annuity, all other factors being equal. As an alternative to a joint and last survivor annuity, a spouse who is named as a beneficiary in a single life annuity contract with a guaranteed payment could receive income in the form of installment payments. Return of premium guarantee. Some insurers offer a return of premium guarantee as a rider to the contract. This guarantee pays the full deposit to the contract directly to the beneficiary if the annuitant dies before the first payment. 3.6. Limitations of annuities. Annuities have disadvantages that the potential policy owner must weigh against their advantages to determine if an annuity is an appropriate investment choice. Risks. Annuities protect annuitants from certain risks, including running out of money during the annuity term, whether it is for a specified period or a lifetime. However, they also expose the annuitant to interest rate and inflation risks. Interest rate risk. Interest rate risk is often associated with annuities, especially when interest rates are low at the time the contract is drawn up. If the policy owner commits to a low interest rate, that commitment cannot be changed. Instead, if rates rise, the annuity payment continues at the original rate. Interest rate risk can be managed during a period of low interest rates by using investment capital to buy a series of annuities acquired over a number of years instead of buying a single annuity. If interest rates rise, the policy owner will benefit from the increased rates with higher payments. Inflation risk. Inflation risk goes hand in hand with interest rate risk. Inflation risk can be managed by acquiring an indexed annuity, even though the cost of the annuity is much higher than an annuity that is not indexed. This means that less is initially received in the annuity payment because the principal must be retained to increase payments in the future. Loss of capital. A life annuity contract without a guarantee period risks the loss of capital. If the annuitant dies, the contract ends. If death occurred just after payments began, most capital deposited to the contract would be retained by the insurance company. This risk is managed by adding a guarantee period and beneficiary to the contract. Adding a guarantee period increases the cost of the annuity. Payments to the annuitant are less when a guarantee period exists. Example. Nicholas, a widower with 2 grown children, receives an inheritance from his aunt in the amount of $450,000. He uses the money to buy an immediate single life annuity, but he does not elect to include a guarantee period. Therefore, a beneficiary is not named. 1 year after annuity payments start, Nicholas dies. Neither his children nor his estate can benefit from the remaining value of the annuity. If Nicholas had opted for a guarantee period that named his children as beneficiaries, they would have received the value of the guarantee. An annuitant may die after the guarantee period ends, and there would be a loss of capital. This risk cannot be mitigated. Restrictions on withdrawal or surrender. There is very little liquidity and flexibility with an annuity investment since there may be restrictions or penalties on withdrawing funds and surrendering the contract. It should be noted that payout and accumulation annuities are very different when it comes to withdrawals and surrender. Withdrawals. Payout annuities did not permit withdrawals. When a market withdrawal is made, a market value adjustment, MVA, may be charged if an investment held within the annuity has not reached its maturity date. The MVA is a penalty based on interest rates, expenses, and the amount of time remaining until the maturity date of the investment. An MVA is not charged if the withdrawal is made from an interest-bearing investment option. If an accumulation annuity is converted to a payout annuity, withdrawals will affect the amount paid out from the annuity. Surrender. A policy surrender terminates the policy. An annuity funded by the transfer of locked-in funds from a registered pension plan, a locked-in retirement account, LIRA, or a life income fund, LIF, cannot be surrendered. A term annuity may be surrendered for its commuted value, which means all future annuity payments are instead received in one lump sum. Surrender of a life annuity may be possible when annuity payments have not started. A portion of the investment capital deposited to the contract is returned to the policy owner. A contract cannot be surrendered after payments from a life annuity start. In contrast to a payout annuity, an accumulation annuity may be surrendered at any time and its cash value received by the policy owner. 3.7. Taxation of annuities. Annuity payments are made up of a blend of investment capital deposited to the contract by the policy owner, and interest earned on that capital. Payout annuities are taxed depending on how they were funded and whether they qualify as prescribed annuities. The growth in an accumulation annuity is taxed annually, if it is held in a non-registered account. The growth in an accumulation annuity is not taxed annually, if it is held in a registered account, as taxation of growth is tax deferred until withdrawal. Taxation of registered payments. When an annuity is purchased with taxable registered funds, such as by transfers from an RRSP, the payment received by the annuitant is taxed as income in the year it is received. A deferred annuity purchased with registered funds is not taxed during the deferral period, as no income is received by the annuitant. Withholding tax is applied to payments when annuities have been purchased with funds transferred from a registered pension plan, LIF, LIRA, or deferred profit sharing plan, DPSP. Withdrawals from a registered accumulation annuity are charged a withholding tax, except if the account is a registered retirement income fund, RRIF. Then, withholding tax only applies on amounts withdrawn above the annual minimum required amount. Taxation of non-registered payments. A withdrawal from a non-registered accumulated annuity must be reported for tax purposes. The interest portion of payments made from a payout annuity purchased with non-registered funds may be taxed as prescribed or accrual, also called non-prescribed income. Accrual income is taxed annually. When an annuity is deferred later than December 31st of the year following the purchase date, it is taxed on an accrual basis. As soon as the income begins, the tax treatment switches to being prescribed only if the annuity qualifies. Whether an annuity is prescribed or taxed on an accrual basis, the amount of income tax paid over the full payment period is the same. The timing of the tax is the difference. Accrual annuity. An accrual annuity payment is comprised of more interest than investment capital in its early years. Consequently, accrual annuities have a larger amount of tax owing in the early years of payments, compared to prescribed annuities. However, tax declines over time as the portion of each payment that is interest declines and more investment capital is paid. Income tax on an accrual annuity is payable on interest earned in the year of purchase from the purchase date to the policy anniversary. Thereafter, income tax is payable on the interest received for the full year and reported on the income tax return for that year. Example. Peter wishes to invest in an annuity to receive payments 5 years from now. Depending on the type of annuity purchased, payments will be taxed on an accrual or prescribed basis. Scenario 1, Accrual annuity. Peter buys a deferred life annuity. He is the annuitant of the contract. His first monthly payment is to be paid in 5 years. The annuity does not meet the conditions to be prescribed because it is deferred beyond December 31st of that year. He is taxed on investment growth annually during the 5 years of deferral. Each of his payments is $800 when they begin, and is comprised of $100 in capital and $700 in interest. Therefore, of the $9,600 he receives for the year, $800 times 12, he pays tax on $8,400 or $700 times 12. After 5 years, each $800 payment is $400 in capital and $400 in interest. After 10 years, the payment is $700 in capital and $100 in interest. Scenario 2, Prescribed annuity. Peter acquires an accumulation annuity contract. He is taxed on investment growth annually. 5 years later, Peter decides to use the savings in his contract to transfer into an immediate life annuity in which he is the annuitant. Payments of $800 are to begin immediately. Since the life annuity meets all the necessary conditions, it is prescribed. The amount of tax he pays is level, that is, It is equal throughout the payment period because each payment will be comprised of the same portion of capital and interest. If payments are comprised of $440 of capital and $360 of interest, on the $9,600 he will receive annually, $800 times 12, he will pay taxes on $4,320 or $360 times 12, for the duration of the payment period. Tax on guarantees. The tax on the payment of a guarantee depends on how the beneficiary of a guarantee receives the proceeds of the contract. When the proceeds are paid as a stream of income, the taxable portion of the payment received by the beneficiary of an annuity would be the same as for the deceased annuitant. If the beneficiary receives the proceeds as a lump sum, tax is paid on any portion of the sum that exceeds the adjusted cost basis of the contract. Tax on surrender. When a policy is surrendered, tax applies on investment growth in the contract unless registered funds are the source of contract deposit. When registered funds are the source of the contract deposit, 100% of the amount received from the surrender is taxed at the same rate as interest in the year it is received. The agent should always seek the advice of a tax specialist when surrender is planned to anticipate the tax consequences. Tax benefits. Annuity income may be eligible for the tax benefits of income splitting and the pension income tax credit. Income splitting allows 50% of the taxable income from a payout annuity to be transferred to a spouse. Tax savings can result when the spouse pays tax at a lower marginal tax rate than if all income is taxed in the hands of the first spouse. Tax rules which govern income attribution may limit the benefits of income splitting. The pension income tax credit is a federal tax credit. It is available to taxpayers with eligible pension income, such as the income paid by an annuity. The maximum credit is $2,000 annually and can reduce tax payable. 3.8. Annuity classification. An annuity must define the lives covered by the contract. 1. Single, or 2. Joint. Timing of payments. Immediate or deferred. Type of funding. Registered or non-registered. Type of payment issued. Level or increasing, indexed. Duration of payments. Term or life. Chapter 4, Investor Profile. 4.0. Investor Profile. What is the purpose of developing an investor profile? The investor profile is a collection of data about the client's financial situation and personal factors. The data is analyzed so the agent can better understand the client's motivations and preferences, and what might influence his investment decisions. To create the investor profile, the agent must review the assets and liabilities of the client to determine his overall financial situation. Personal factors that may affect the client's investment decisions. Client needs and objectives. Sources of income during retirement. Programs and savings plans that can help the client to save and meet his needs. 4.1. Financial situation of the investor. Information about assets and liabilities is first gathered so the client's financial position may be evaluated through a net worth statement and a cash flow statement. Net worth is the value of an individual's assets after deducting his liabilities. Cash flow determines how much money is available for spending, saving, and investing. Review of assets. Assets are anything a person owns with cash value. The single most valuable asset most people own is their home. Other valuable personal assets include investments, a vehicle, fine jewelry, art, and specialized equipment such as tools or cameras. Assets are important for both their value and the collateral they provide for the purpose of borrowing. Personal assets are listed to see the plus side of the net worth statement, also called a balance sheet. Their value shows the complete value of personal assets as well as progress made in building worth. The following elements provide information about an investor's personal assets. Income tax return. Income is reported on the annual income tax return. Corporations file separate returns. After the income tax return is filed, the Notice of Assessment, NOA, is issued by the Canada Revenue Agency, CRA. Taxpayers in Quebec receive a NOA from Revenu Quebec. The key information shown in the personal income tax return is amount of taxable income, how that income is earned, and use of tax credits and deductions, including RRSP contributions. The NOA summarizes total income, amount of tax paid, amount of tax owed, tax credits received, Deduction room available for an RRSP. Unused net capital losses. Tax-free savings account, TFSA, contributions, withdrawals, and unused contribution room, and other necessary repayments, carry forwards, and rebate information. Income can be earned from multiple sources in addition to employment. For example, from a personal business, retirement pensions, investments, or spousal support. Dependability of the income is essential to planning. For example, business income could vary year to year, but income from a government retirement pension would be stable. From this information, the investor and agent know what can be counted on for income in future years. Contributions made to registered savings plans demonstrate the investor's current dedication to savings. The deduction limit for RRSPs is calculated based on earned income. It shows whether contributions are currently maximized and is a basis for planning future savings. Tax credits and other deductions reduce income tax. Charitable giving is reflected in the charitable donation credit. The pension income tax credit can demonstrate whether a strategy for splitting retirement income could be implemented, since the tax credit must be claimed before income splitting can occur. The taxpayer generally pays tax at his marginal tax rate, MTR, which combines federal and provincial tax rates. It is important to consider the MTR when choosing investments and planning on using investment income due to its effect on the net amount available for retirement. Registered Retirement Savings Plan, RRSP, Statement. The financial institution holding an RRSP issues regular statements. These statements show an account summary. An RRSP statement can show many details, including the sum invested, growth of the sum invested, how the sum is invested, whether the account holds locked-in funds, and withdrawals. There is no limit to the number of RRSP accounts a person may have. Therefore, an individual may have multiple RRSP statements. However, annual contributions to all accounts, including a person's own RRSP and a spousal RRSP, are limited to the annual maximum, plus the available deduction limit, which includes the carry forward of unused deductions from former years. An overcontribution of $2,000 over and above this amount is allowed before penalties are incurred. It is very important for an agent to see how the money deposited to the RRSP is invested. This could reveal investing expertise and knowledge, the investor's exposure to risk, portfolio diversification, and maturity dates. An account with locked-in funds restricts transfers and withdrawals. The money is locked in because it has been transferred from a registered pension plan, RPP, or another locked-in account. Locked-in accounts will be addressed later in this chapter. Withdrawals from an RRSP may demonstrate that the investor has had an exceptional expense or has a need to supplement his income. A conversion of the account to a registered retirement income fund, RRIF, or annuity may be advisable if withdrawals seem to occur on a regular basis. The absence of an RRSP statement can also be revealing. It may show the investor does not understand the significance of having an RRSP or does not have funds available for saving in an RRSP. If the RRSP has been closed because the investor has surpassed the age limit for owning an RRSP, statements from other types of registered accounts may be available. An agent uses the RRSP statement to discern the value of this asset and the overall assets of the investor. Non-registered investment account statements. Just like an RRSP statement, a non-registered statement will summarize the main aspects of an investment account. Unlike an RRSP, there are no limitations imposed by the Income Tax Act on either deposits or withdrawals to the account. This statement presents further detail regarding how the investor tends to invest as well as how much is available to contribute to net worth. Pension plan statements. A pension plan statement, also called a member's benefit statement, is issued on a yearly basis by employers who have a registered pension plan for their employees. An employer's pension can provide a dependable source of retirement income. This makes it a valuable asset. The statement may include the expected value of the pension to be received at the standard age of retirement. Other information can include contributions made during the year and the expected retirement date. This information is essential to knowing how much will be paid and when. Contributions made to a registered pension plan by individual, as well as calculated pension adjustments, PAs, reduce his RRSP deduction limit. Bank statements. Bank savings are sometimes used as an investment. It is essential to review bank statements to determine how much is available to contribute to total assets. Life insurance policies. Life insurance policies with a cash value are an asset since this value can be accessed by the policy owner. This includes whole life insurance and universal life insurance. The cash may be received as a cash surrender value, or policy loan. Withdrawals may also be permitted by universal life insurance policies. Other asset sources. Multiple assets have worth or contribute to overall worth. For example, a business owner has asset value in his business in proportion to his share of ownership. An inventor or designer may have an asset in a patent or intellectual property and receive royalty income, or a real estate investor may have rental properties with asset value and receive rental income. The financial review should encompass all assets. Review of liabilities. Liabilities, unlike assets, reduce personal worth. Liabilities are debt and financial obligations that must be repaid. Sometimes a distinction is made between good debt and bad debt. In both cases, the debt must be repaid by the borrower and included in the review of liabilities. Good debt is borrowing taken on to increase assets, that is, a loan used for investment purposes or, in some cases, a mortgage, and bad debt is debt that reduces income and financial resources, that is, credit card debt. The following documents provide information regarding the personal liabilities of an investor. Mortgage statement. An individual's mortgage is likely to be his largest liability, just like his home is his biggest asset. Every year, the financial institution that holds the mortgage on the property issues a mortgage statement to the borrower. The mortgage statement largely presents the amount owed, the principal and interest charge of each mortgage payment, the interest rate applied to the mortgage, and the mortgage term and its amortization. A mortgage statement can also show a reverse mortgage is in place. A reverse mortgage is a payment of a proportion of home equity to the homeowner in a lump sum or a series of payments. It is a liability that may have estate planning considerations because the home equity received by the deceased homeowner will need to be repaid by his estate. Line of credit statement. An individual may receive a line of credit based on his creditworthiness and collateral. A line of credit may be extended to homeowners based on their equity in their home. This is called a home equity line of credit, HELOC. The line of credit statement shows the amount owed, the minimum monthly payment required, and the interest rate charged against the amount of loan extended. Credit card statements. Credit card statements are issued monthly. The credit card statement shows charges incurred during the month, a separate charge for interest and cash advances, balance of the account, the rate of interest charged, and the minimum monthly payment. Financial position of client. Assets and liabilities are compiled to form a financial profile in the net worth statement. Income and expenses appear in the cash flow statement and are added to the profile. The result shows the possible amount available for investing. Net worth statement. A net worth statement is developed by listing all assets at their market value and subtracting all liabilities. The final sum is the net worth of the individual or couple whose assets and liabilities are listed. Net worth equals value of all assets minus value of all liabilities. A common goal of financial planning is to increase net worth to meet financial goals. Net worth is increased by acquiring more assets, increasing the value of existing assets, for instance, through a home renovation, and decreasing liabilities. A net worth statement is a benchmark against which goals can be fixed and future increases in worth can be measured. Example. Net worth statement for John and Jean H., as of date. Assets. Home. $526,000. Cottage. $360,000. 2 vehicles, owned. $40,000. RRSPs. $105,000. TFSA. $3,300. Life insurance CSV. $22,000. Cash. $7,100. Total assets. $1,063,400. Liabilities. Mortgage, home. $112,000. Mortgage, cottage. $86,000. Line of credit. $23,600. Credit cards. $8,900. Car loans, $5,300. RRSP loan, $4,400. Total liabilities, $240,200. Net worth, $823,200. Cash flow statement. The cash flow statement can be prepared for a period from a month to a year. The cash flow statement is most precise when it is supported by a budget based on actual spending patterns. The cash flow statement presents the rate at which assets are being accumulated or used. The cash flow statement shows all sources of net income, income after income tax, and subtracts all expenses, including debt payment for liabilities and potential child and spousal support. If a positive number results, money is available for spending, saving, or investing. If a negative number results, a debt management solution may be necessary, savings may have to be used, or assets may need to be sold to pay down debt. Example. Please see table for cash flow statement for John and Jean H., as of date. 4.2. Personal factors that affect investment. Many personal factors and preferences motivate investing decisions. They include the following. Personal values. Personal values influence an individual's investing approach as well as investment choices. For example, some people may value saving for education over saving for retirement. Others may value charitable giving over enlarging investment portfolios. The agent must learn if the values will affect his client's decisions to develop suitable recommendations. Health concerns. Healthcare costs can become significant with age and diminish the value of an estate. Therefore, healthcare costs introduce the risk of outliving one's money. Financial planning should take into consideration the potential need for financial resources later on to pay future healthcare expenses. The financial plan should take these expenses into account well before the money may be needed. This ensures sufficient savings are set aside for care in later years. The need to pay for care also introduces the potential need for long-term care insurance and critical illness insurance. The agent should take into account his client's mental capacity to make sound investment decisions. This is important because the client's mental capacity can be impaired due to disability or getting older. Particularly, when the client gets older and important decisions regarding the client's estate and retirement income must be made, the agent must potentially be prepared to guide decision-making based on the knowledge he has developed of the client. He must also be alert to signs that decisions being made are inappropriate. The risk of disability should be examined along with other health concerns. This risk is best managed by ensuring that disability income insurance is in place for the income earners of the family. Disability can have a harmful and lasting effect on income and wealth accumulation. Other health considerations that may affect the investor profile are the need to save to provide an income for a disabled child, and to use financial resources to pay for care for aging parents. Legal considerations. The investor profile must take into account legal obligations to others that have a financial impact. Family law. A person in a married or common law relationship has a financial responsibility to his spouse, whether the same or opposite sex when they separate and divorce. Note that Quebec is an exception for common law relationships. Family law attempts to equalize the assets of both parties in these circumstances, including investment property. Consequently, a spouse has rights regarding investments and their proceeds. A parent also has financial duties to children, from both past marriages and one's current marriage. Child or spousal support must be paid and its cost factored into financial obligations. Will. Developing the investor profile calls for review of the will to see what commitments are planned for the value of the estate. Bequests in the will must be supported by the necessary financial resources or they may remain unfulfilled. In general, a surviving spouse can obtain all the assets of a deceased spouse on a rollover basis, meaning that any taxes are deferred until the death of the second spouse. Careful planning is required to meet bequests made in the will. If investment proceeds are set out for a particular purpose, then the gifter should ensure an adequate amount of money will be available for the property's inheritor. These cases may require investments with guarantees, that is, segregated funds or a life annuity with a beneficiary, so the gifter is assured his wishes are carried out. Life insurance is essential for fulfilling estate plans. Power of attorney. The power of attorney is essentially a document that nominates a person to act on behalf of another when specified circumstances arise. It often accompanies a will. Powers of attorney differ from province to province. A power of attorney for property can designate a person to take care of investments on behalf of another in a situation where suitable decisions cannot be made or implemented by the investment owner. When developing the background knowledge for the investor profile, the agent should include whether a power of attorney has been given, to whom, and what his powers are, in order to determine in what circumstances he should be consulted. Personal risks. Each investor faces personal risks that can affect plans for savings and investing, such as the following. Low level of financial literacy. Financial literacy is the ability to understand the fundamental matters of personal finance. Individuals differ greatly regarding their level of financial literacy. The agent should never make assumptions based on what a client appears to know or ought to know. Financial illiteracy, that is, a lack of knowledge and understanding about financial products, can lead to an unnecessarily low tolerance of risk, which in turn can lead to low returns on investments. The agent should assess his client's financial literacy and explain to his client any necessary information regarding investments, proposed plans, and the effect of risk tolerance. Information must be properly communicated to the client, both in writing and verbally. In some cases, when the client's language skills are limited, the agent will have to call on an interpreter to communicate with the client in the client's language. The agent should avoid the use of acronyms and jargon, that is, use the term marginal tax rate opposed to MTR. Financial institutions, insurers, and financial regulators provide educational resources that can be useful to help improve the client's financial literacy. Risk of job loss. Job loss can have a harmful effect on investment and savings plans. An emergency fund, that is, savings to cover living expenses for a minimum of 3 months and up to 6 months, could help reduce the impacts of job loss. If job loss occurs, the investor profile should be reviewed right away. Plans may need to be put on hold before irreversible changes are made that relied on continued employment. Longevity risk. People are currently living longer in Canada than ever before. Despite the increase in life expectancy for both men and women, the age of retirement currently remains at 65. Note that the retirement age is stated to gradually change, over a year period, to 67 years in 2023. Therefore, retirement savings must last longer. If retirement savings are drained and run out during the lifetime, an individual is said to outlive their money. Longevity risk can be managed by insurance, specifically, investments that provide lifelong income, such as a life annuity or a guaranteed lifetime withdrawal benefit. Risk of bankruptcy. Bankruptcy occurs when an individual or a company is unable to meet financial obligations to creditors. Risk of bankruptcy is mitigated by financial management, and, for individuals, choosing a careful selection of investments that can provide creditor protection, such as segregated funds. Risk of leveraging. Leveraging is when an individual uses borrowed money to attain a financial goal. Some forms of leveraging are common and are considered safe, such as acquiring a mortgage to purchase a home and develop the equity in the home. Some forms of leveraging are considered riskier, such as using a loan to invest in non-guaranteed investments. If the investment loses value, the investor has lost principal plus he owes the amount of the loan. Therefore, leveraging can either boost returns since it gives the investor a greater sum to invest, or amplify losses since the investor loses his savings plus the borrowed sum. The client's knowledge of leveraging is essential to the investor profile since it speaks to investor goals and risk tolerance. 4.3. Investor needs. The investor's needs are essential to develop the investor profile because needs override wants. Needs represent the reasons behind the investor's motivation for exploring investment options as well as making investment decisions. The agent's role is to recognize and understand the needs that affect plans and decision-making. These include the following. Need for income. Income is a necessity to pay the costs of living and for saving. Goals must be realistic and identified with an assigned dollar value to give meaning and purpose to savings plans. If there is not enough income, or only just enough, to pay for the costs of living, then any plans for savings must wait until there is an increase in income or a decrease in costs. Individual or household income needs. There are 3 groupings of individuals in which there will be a need to examine the income needs of an individual. Those who are unmarried and not in a common law relationship. The widowed. Those who are separated or divorced. To create an accurate picture of an individual's financial situation, individual income needs must be compared against individual expenses. The shared financial situation of couples should be assessed according to the household or family income. This encompasses both income earners and household expenses. For both individuals and couples, the income needs of dependents should be taken into consideration. Income needs may be expressed in terms of present and future needs. For instance, if an investor profile needs an increased income in the present, the agent may want to reassess the individual's budget to detect spending behavior. The investment plan's focus should concentrate on meeting future income needs. Such a plan is based on goals for the future. Need for retirement income. Retirement income is the regular input of money needed to meet retirement expenses. Retirement income replaces or supplements employment income when a person retires. Income sources during retirement can include government retirement pension income, private pension income, investment income, personal savings, employment income since some choose to continue work post-retirement, business income. The business owner may not be actively working in the company but still receive a salary or dividends. An essential factor when assessing the amount of income needed during retirement is the income tax that will be due on amounts received. Therefore, spending should be based on net income, that is, income remaining after tax. Income splitting. Income splitting takes advantage of the different marginal tax rates of spouses. When spouses have the same marginal tax rate, income splitting serves no purpose. Income splitting apportions income between spouses so that some income is moved to a spouse who pays tax at a lower marginal tax rate than the other. Therefore, the couple saves money putting income into the hands of a spouse who pays tax at a lower rate. Some examples of effective income splitting include opening a spousal or common law partner or RSP. The higher income spouse makes payments to the plan for the other spouse. This works for income splitting if the spouse receiving the contributions is in a lower tax bracket than the contributing spouse when withdrawals are made. This is referred to as a spousal or common law partner plan. Splitting pension income for those 65 and older. Up to 50% of the annual income received from a lifetime annuity, registered pension plan, RRSP annuity, registered retirement income fund, RRIF, or deferred profit sharing plan, DPSP. Annuity can be allocated to a spouse. The splitting for tax, SPSP, purposes is done via the tax return. Assigning Canada Pension Plan, CPP, benefits. CPP can be shared between spouses who are contributors, or between spouses when only one was a contributor. This is called an assignment. Quebec Pension Plan, UPP, sharing is also available for couples who are married or in a civil union or living in a common law relationship of at least 3 years duration. Example. David receives $18,690 per year as a pension from his former employer. His marginal tax rate is 37%. He could pay as much as $6,915.30 or $18,690 times 37% in income tax on his pension. David's wife, Beth, has a marginal tax rate of 29%. David splits his pension with Beth, so they each declare $9,345 or $18,690 divided by 2, as income. David's income tax payable becomes $3,457.65 or $9,345 times 37%. Beth's income tax payable is $2,710.05 or $9,345 times 29%. Together they pay $6,167.70 in income tax, $3,457.65 plus $2,710.05, a saving of $747.60 or $6,915.30 minus $6,167.70, compared to the tax due if David did not split his pension income. There can be an added advantage for the retiree who receives Old Age Security, OAS, pension benefits when income splitting. The OAS pension is completely forfeited by the pensioner when net income reaches a specified level and partly repaid when income exceeds a threshold level. Therefore, the amount of repayment, also called the clawback, is reduced when income is reduced by income splitting. Need for tax efficiency. Using tax credits is another way to reduce income tax. Federal and provincial or territorial tax credits are available. Some tax credits are non-refundable. They can reduce income tax. But if the total credits surpass federal tax, a refund is not issued for the balance. It is important for the taxpayer to use all tax credits to which he is entitled to ease the burden of taxes. Need for emergency fund. An emergency fund is a readily available sum equivalent to a minimum of 3 months' living expenses. It is to be used strictly for payment of unexpected expenses or to replace income that is suddenly lost. The review of assets shows whether an emergency fund has been created. If not, the agent can assist the investor to create an emergency fund with a high degree of liquidity to be available as needed. Need for creditor proofing. A creditor is a person or company that is owed money by another. The amount owed is the creditor's credit to the debtor, that is borrower. A creditor has rights and recourses to attain the repayment of the amount owed. An asset is creditor-proofed when a creditor cannot legally obtain the debtor's asset or its value for repayment. Creditor proofing should not be a standalone exercise or be the sole motivation for investment choice. An investment should first be chosen based on how it meets the full scope of client needs. If creditor proofing is available, it should be considered as coincidental, merely as a one feature of an investment product. The investments may be seized if it appears in bankruptcy proceedings that the investments were chosen primarily to defeat creditors. An investment must be chosen for the contribution it makes to net worth, not to escape monetary obligations. Need for liquidity. Liquidity refers to how easily a person or company can retrieve cash. This includes converting assets into cash. Liquidity in some assets is essential to help a person in the event of a disaster or personal hardship. For example, if a person found himself in grave medical condition while traveling, he would need access to cash immediately to pay for required medical care. An assessment of assets will show if there is liquidity in the investor's portfolio. Need for estate planning. The net worth statement determines if assets are available to create an inheritance for children, family or friends, or for a charity. The cash flow statement shows the rate at which assets are being accumulated or used. Individuals who wish to leave an inheritance when they die must make plans in advance regarding their estate to ensure that bequests can be filled according to their wishes.